Good afternoon, everybody. Nice to see you all here. My name is Tom Berry. I'm the Chief Marketing Officer at CFA Institute. So it's my great pleasure to welcome you all to the final of the CFA Institute Research Challenge. So many of you already know this, but the Research Challenge is now in its 19th season. But this year was the largest competition ever. With 7,000 students participating in 120 local competitions hosted by our fantastic CFA societies across the world. In total, an incredible 1,153 universities competed, and that's making this the largest and most prestigious global competition of its kind. So it probably goes without saying, this is a huge achievement that everybody's here in this room. I'd like to thank everybody who has volunteered their valuable time to make the Research Challenge possible. Our local society hosts, industry mentors, faculty advisors, the report graders, and the judges. So your generosity in sharing time and your expertise in support of these students is so greatly appreciated. I would also like to extend my gratitude to two colleagues who are fundamental to the success of the program, Samantha Bray and Adrian Goodhall. Thank you, Samantha and Adrian. So why does CFA Institute continue to host the Research Challenge? Well, many of you will also be enrolled in the CFA program, and if not, now might be the time to do it. And this is a signal to employers that you're committed to meeting the technical knowledge and ethical foundations required of today's leading practitioners. But it's not just about technical know-how and passing exams. The investment industry demands well-rounded individuals who bring other skills to the table. Skills that you'll practice today and through the competition: teamwork, effective communication, and critical thinking. So whatever you do next, don't forget to add this to your resume. With that, it's time to get the final of the competition underway. My colleague Peter Watkins will take you from here. And I'd like to finish with my personal congratulations to each of you for reaching this point today. And best of luck.
So hello, everybody. I've seen many of you on video calls throughout the competition. It's lovely to see you in person. My name is Peter Watkins. I'm Senior Director for University Programs at CFA Institute. And I'd like to add my own sincere congratulations to all participants here. And also a big warm welcome to our audience. We have quite a few people here. We've been so impressed with the quality of the presentations over the last months. Unbelievable, actually. And I hope the audience will also be equally impressed. I'm sure they will be. Well done for all that you've achieved so far. Enjoy the session today. Try to remember that we're all on your side. We want you to do well. This is what the environment is here. We're very much on your side and wishing you well with this. So, to the business of the day. It's time to recognize the 6 universities who've reached today's global final. From the Asia Pacific region, the University of Hong Kong, representing CFA Society of Hong Kong, and the University of Sydney, representing CFA Society Australia. From the Europe, Middle East and Africa region, Kozminski University, representing CFA Society Poland, and University of Neuchatel, representing CFA Society Switzerland. And from the Americas, Appalachian State University, representing CFA Society North Carolina, and University of Waterloo, representing CFA Society Toronto. We're indebted to our esteemed global panel of judges today. So we have Glenna Anderson, CFA Equity Analyst from CFA Society Chicago, Emma Mugo, CFA Portfolio Manager at Gen Africa Asset Managers, CFA Society of East Africa, Guillermo Rodriguez, CFA Head of Latin America and US Offshore at Wisdom Tree, CFA Society Miami, and Chang Hwan Sung, CFA Portfolio Manager at Invesco, CFA Society Korea, South Korea. It's time for the competition to begin. Teams have been fully briefed on the rules, but for others, I'll just explain that we've drawn lots to get the order of the teams today. They will present on their assigned company for 10 minutes and then have 15 minutes of Q&A at the end. All teams will remain in a waiting room before their time to present. We wish you all the very best of luck. All participants may now leave the room. So we're now ready to begin, and I'd like to introduce to the stage the University of Waterloo.
Okay.
Bombardier Recreational Products, one of the largest players in North American power sports, is poised to ride the wave, firing on all cylinders as it races ahead. We initiate coverage on BRP with a $62 price target and an implied upside of 33%. BRP is a high-quality business gaining market share and currently trades at a discount due to transitory reasons, creating an attractive entry point. Our recommendation is underpinned by three key thesis points: BRP's unique position, structural moat, and innovation capabilities. This is supported by extensive primary research such as 50 expert and dealer calls, 16,000 products web scraped, and over 100 consumers polled online. To show BRP's daily ESG practices, we've placed ESG stickers throughout our presentation as shown on this legend.
Now, BRP is a leader in the powersports industry, a category of high-performance motor vehicles. The majority of their revenue comes from their year-round vehicles, with 30% coming from their seasonal vehicles, and the remaining 15% coming from their parts and accessories segment. BRP's marine segment is currently undergoing a sale process that will increase their financial flexibility, which we see as a major catalyst for the company going forward. Now, BRP owns its value chain, which helps allow the company rapidly scale their production while maintaining their high-quality standards. In speaking to management at BRP's largest competitor, Polaris, we learned that BRP's more streamlined supply chain allows them to bypass additional tariff exposure that Polaris faces. Now, once these vehicles are finally assembled, they're then sold to both individual dealerships as well as a network of distributors.
Now to look at the competitive landscape for powersports products. The closest peers for BRP are Yamaha and Polaris. Yamaha is a smaller competitor, not competing in the three-wheel vehicle segments and snowmobile segments, while Polaris is a larger competitor, competing in all the same product segments as BRP. To better understand the landscape of powersports consumers, we conducted two surveys. In the first survey, we learned that over 85% of powersports buyers buy a new product every 1 to 10 years, making them enthusiast buyers. In the second survey, we learned that buyers care most about quality, price, and performance, and BRP is best poised to capture these demands. Since 2015, BRP has grown its market share by 8%. In the same time period, Polaris has not gained any market share, and other peers have lost market share.
Despite these market share gains, BRP stock is underperformed. This is due to two main reasons. First, a recent decline in consumer sentiment is bringing concern around the average powersport buyer. Second, tariffs have significantly re-rated BRP stock despite less than 1% of their COGS being subject to potential tariffs. Therefore, we believe that today presents an attractive entry point for BRP, a high-quality business capturing market share that is trading down due to transitory reasons. We believe that BRP will be able to re-rate back to its average mid-cycle multiple, thus justifying our 33% upside.
Our first thesis is that BRP is uniquely positioned to navigate macro headwinds. While the industry has largely stabilized, tariffs bring in new concerns, though we view this as an opportunity for the market to recognize BRP's relative strength, driven by three key advantages: an inelastic, high-income customer base earning well above the industry and supporting pricing power, a high-margin premium product mix, and strong dealer preference, reinforcing BRP's floor plan edge. Now, BRP's premium strategy is strong and backed by a customer base earning well above the industry. We saw this play out earlier this year, where strong sales in premium products help protect margins despite weaker sales in value items. Now, if premium demand softens, BRP's broad and high-quality lineup keeps the brand competitive across price points and keeps optionality open for consumers. Now, to move product, you need strong dealer incentivization, and BRP delivers. With 12 to 16% margins that outpace peers, BRP is simply more profitable to sell. And our web scrape analysis shows that BRP cleared older inventory faster, making room for the high-turn, high-margin inventory that dealers and consumers actually want to buy. As a result, better dealer economics reinforce BRP's floor plan edge. Finally, our analysis of tariff exposure across OEMs shows that BRP comes out on top, with a materially lower COGS impact thanks to limited sourcing from China. That said, in our worst-case scenario analysis, tariffs could result in a $230 million EBITDA hit for BRP, which is slightly below what the market's already pricing in. Therefore, with this risk adequately accounted for in the stock price, we believe that now presents a strong setup to own a high-quality name built for resilience and ready for recovery.
Our next thesis is on BRP structural moat as a result of accretive investments that will underpin continued market share gains. Now, BRP has continually out-invested peers, with their return on invested capital well outpacing both their peer average as well as their WACC. We anticipate that BRP will only continue to fortify this moat as they invest more than peers, continue to see growing profitability, and as they generate returns on capital from internal sources. Now, investments in production capacity are foundational to BRP's ability to capture market share. In the snowmobile segment, BRP's manufacturing moat in key regions will allow them to immediately capture 5% market share, adding $100 million of incremental revenue to BRP in 2025. Now, in the rapidly growing side-by-side vehicle market, BRP has made recent investments to unlock an additional 10% market share capture availability, which will only continue their rise in the segment. Now, BRP uses these structural manufacturing advantages to deliver the highest quality product. BRP has made efforts in nearshoring that increase the ability to integrate proprietary durability features at significantly lower costs, and BRP continues to source from high-quality suppliers, where their largest competitor Polaris has shifted their focus towards sourcing parts from low-cost countries. Now, these quality differences, echoed by the many experts and dealers we spoke to, are clearly reflected in BRP's significantly lower recall rate than of Polaris.
Our third thesis is that BRP's innovation is driving market share gains. BRP has succeeded in their investment in innovation, as best shown by our proprietary analysis of return on R&D. BRP has outperformed peers, and we believe that this trend will continue. We spoke to a former head of design at BRP, and he told us the story of the Sea-Doo Spark. He told us that management came to him and challenged them to create a product that's 50% cheaper than peers' products while still maintaining the same level of quality and the same level of product design. They came out with the Sea-Doo Spark, and it accelerated industry growth more than any other product. In fact, it was the sole driver of industry growth from 2014 to 2016, leading to market share gains. We believe that this trend is structural and is part of BRP's culture, as best shown by their 2025 model year. As one analyst put it, BRP's 2025 model year is the most productive to date, with 5 new products compared to Polaris, who focused more on refreshing existing products. From our survey of over 50 consumers, we found that the increased power, the improved product, all at an affordable price, is bringing customers to BRP and away from Polaris.
Moving on to environmental, social, and governance, we developed a proprietary ESG scorecard to assess material issues in the powersports industry and found that ESG factors pose no major risk to our evaluation. BRP has reduced CO2 emissions and leads in it, as well as innovation has led to sustainable manufacturing, which translates to higher gross margins. BRP has a declining injury rate, and innovation and excellent product quality leads to reduced balance sheet liabilities. Looking at governance, BRP is led by a highly experienced management team with an average tenure of 30 years, a stark contrast to Polaris's of 12. This is a key factor in navigating macro challenges and driving product innovation. One risk is the sponsor overhang and dual-class ownership in the company by the founding family, Bain Capital, and CDPQ, which result in the stock trading lower than peers. However, we believe that the coattail agreement, along with these shareholders' long-standing involvement, board representation, and track record of value creation are all positives for BRP, and it should not be penalized further for this.
Now looking on to valuation, risk, and mitigants. On a relative valuation basis, BRP trades at an 18% discount to its peer median. This discount is driven by 3 main factors. Number 1, the market views the temporal market share loss by BRP during its destocking period as structural. Secondly, it takes a negative view of the liquidity discount arising from the dual-class share structure. And lastly, the market is uncertain about the impacts of tariffs on the company. To intrinsically value BRP, we took a top-down approach. We multiplied the industry units sold by BRP's market share. Under our base case assumptions for our forecast period, we see that there's going to be no growth in industry units for our forecast period. We see there's going to be a market share capture of 1% per year, pricing growth of 3% per year, reflecting BRP's continued premiumization and innovation across its product lines. And further, we see that BRP is going to offset its tariff impact by pricing passed down to consumers at a rate increasing revenue by 1% per year, resulting in a 5% revenue CAGR during our forecast period. Now, during the same forecast period, we also forecast that operating margins are going to improve as a result of lower rebates in their cost of goods sold. However, we think it's going to take them longer to return to pre-COVID levels because of the negative impact of tariffs. Now, combining our valuation methodologies, we get a target price of $62 or an implied upside of 33%.
Now, despite our confidence in the recommendation, we note a few risks, namely BRP's elevated leverage ratio and high DIO post-COVID, both driven by softer demand. This results in a 3% downside to the current stock price. However, we believe this risk is adequately mitigated by BRP's covenant-light structure and 20% reduction in inventory write-downs over the past year, pointing to better demand alignment and more room for the high-turn, high-margin inventory that will lead to their improvement in cash conversion. With that, we'd like to thank you, judges, for your time. We'd like to reiterate our buy recommendation on BRP, founded under structural moat, innovation, and unique positioning. Thank you, and we open the floor to any questions.
Okay. First, congratulations on your presentation. I've been involved in Research Challenge for many years, and it's a great effort what you do here. My first question, I'm originally from Mexico, and I have seen the exchange rate. And given that you have several of your production plants in Ciudad Juárez and in Querétaro, do you think that there will be an impact of the exchange rate given the high volatility that we have seen in the past few months?
Yeah, so we think the biggest exchange rate from understanding is like the Mexican peso and the US dollar. And what we see with those two exchange rates is the Mexican peso right now, we do think is going to be strengthening a little bit more against the US dollar because as the US is trying to really bring a lot more manufacturing onshore and we are forecasting a rate cut, we think that's going to be sort of tailwinds for the Mexican peso to get stronger. So that's the way we view the exchange rate between the peso and the dollar going forward.
And what will be the impacts on sales costs?
So we do forecast at that point in time, the COGS would end up going a little bit higher because we're seeing that they're not going to be able to get as much as sort of that revenue bump coming in when you convert it up in the US dollar.
Okay, because I mean, the peso has moved in a range of 20% from 16 to 21. Now it's back in the 16, and it's a big change, no? So that should have a big impact on your cost and
For sure. And we completely understand that risk. And we actually had a very similar question. So we actually ended up talking to an expert who's actually worked in BRP's management previously. And we wondered why maybe they wouldn't hedge something like that. The answer is because the enthusiast consumer makes up 80% of BRP's buyers. So BRP feels that they can pass on these potential fluctuations and costs down to the buyer because they're willing to buy the product despite the fact that it might increase in price at, say, a 5% CAGR. And so that's what we think about those potential risks.
My question is on the tariffs. You said that you were able to quantify that the market is punishing the stock much more than your estimations based on the impact on the tariffs. I was wondering if you could explain how you quantified the impact of the tariffs on the revenues going forward.
Yeah, for sure. So if we could go to our tariff bridge. So what we did is we factored in 4 main drivers that would impact BRP stock based on tariffs. So one is a 15 to 20% decline in your non-reoccurring buyers. So these are your infrequent buyers who are new to the industry. And second to that, we actually factored in a 25% price impact from the tariffs. Again, if the U.S. is to impose that 25% tariff on U.S. and Mexico, Canada imports. And moving on to that, we also factored in actually positive mix benefits because BRP is premium. They're actually able to pass that cost through. And again, that's also factored in as well, where we factor in a 3 to 4% price pass through, including a 1% price pass through tariffs, which would also be a positive for BRP. And that netted results in a $230 million impact that we forecast would be hit for BRP.
Can you talk about you mentioned the Spark, that it is 50% cheaper and but still had the same quality and design as competitors. Can you talk about how they did that and why you think that's ingrained in their culture?
Yeah, it's a great question. And we had a similar question for someone who was formerly on the design team of BRP. They were able to do it by using cheaper materials that were actually bonded together using new bonding techniques. The issue is that with something like a strong engine that the product has, it could rip apart some of these components, and some of these components are really expensive. And so they actually were able to reduce that by coming up with new innovative techniques to create the product. Now, to answer your second question of why do we believe this is part of their culture, because they've always been the leader in innovation. So for example, companies have actually come out and tried to replicate similar products to BRP 5 or 6 years down the line without success. So BRP has always been the leader in innovation. They're able to capture price as a result, and they're able to have higher margins than their competitors as a result of that as well.
Yeah. Let me ask you a question. So, I originally thought this would be like like a discretionary spending kind of product, but you mentioned that they have a lot of enthusiastic buyers. So, can you tell me, you know, what is the big picture revenue breakdown by country, and if a potential recession hits in those major markets, what would be their impact on the like revenue and net profit?
Yeah, I can start with the revenue breakdown. So the majority of BRP sales are to America, with about 20% to Canada as well. However, we believe, as to your point, a very enthusiast customer of 80% of these customers are reoccurring buyer and enthusiasts that have taken historically 3 to 5% price hikes every year. So we're confident that their higher average annual income compared to regular power sports buyers of 165,000 is well insulated against any potential terror or recession impacts.
And just to add a quick follow on, 25% of BRP's revenue is actually to international segments, so beyond North America, while Polaris is 14%. And so we believe this is also a strong mitigant because the North American power sports market was hit harder than the global power sports market as well.
I have one question. On one of your slides, you present the discount to historical and intrinsic value, the multiple, the enterprise value to EBITDA. Why do you think it's so low now compared to uh, the peer group? I mean, because the peer group is 9.9 and you are at 6.4. So something is the market looking that you are not looking.
Yeah. So two main reasons. One, we think that the general market is more optimistic on BRP's peers than BRP itself. There's some uncertainty around BRP because of their potential tariff exposure. However, we actually believe that BRP is better positioned because companies like Polaris have significant exposure to China. So it's a bit of that uncertainty. Second, on this slide here, what we notice is that BRP's multiple is usually highest when its earnings is at its lowest. And that is because the market is trying to front run the increase in earnings that will come subsequently after that. So we feel that the multiple is declining because the market does not believe that the earnings have quite bottomed out yet. We would disagree because we believe that management has conservatively forecasted their EPS of between $4 to $5 for the upcoming year, which would be lower than their last year earnings. And they've also sold one of their businesses, which was an earnings drag. And so that's a bit more context on why their multiple is the way it is.
What is the impact on tariffs different to BRP compared to the peer group?
Yeah, for sure. So if we could go to actually the tariff rate that we have, you can see that BRP actually sources significantly less from China, where the tariffs are actually being implemented, versus BRP, because they actually have a majority, actually, if not all of their manufacturing in Canada and Mexico, those products are all USMCA compliant, which are not hit with tariffs, which is why we're seeing that since their production is actually much more localized compared to competitors like Polaris, Yamaha, CF Moto, who is entirely China based, their impact on COGS from tariffs is significantly lower.
And if it's lower, why is the multiple so low?
We just believe that the market is misunderstanding this concept. So when you look at what equity research is saying, what you hear market participants are saying, they're concerned because BRP has 65% of their production in Canada or Mexico, and then 60% of their revenue subsequently into the US. So the market is just concerned about that uncertainty, and we feel that is placing a discount on the stock. We now feel that that discount is adequate, which presents a strong entry point for BRP.
Okay. Not sure if I agree, but okay.
So how does then I'm assuming your earnings ends up versus consensus. Are you higher than consensus at this point?
Yeah, so we're currently allowed set. So majority of the equity research that has us a buy rate on a company has a target price of $63, and we're at $62, and we believe we're in line with that. It's the majority, the 55% of it is gold ratings, and that's where we think we differ, and we're higher than consensus with those analysts.
Your earnings are higher than consensus?
Yeah.
Go ahead. So one question. So first question is kind of follow up from my previous question, and since you looked at DCF, I believe you calculated data. What data did you use for this company? That's the first question. The second question is, if the major competitor, how can a major competitor not come up with a new innovative, product or design this year while they come up with 5 new product or design? Are they maybe a bit too haste in trying to time the market? Is there something wrong with the competitor? I mean, how can that happen?
Yeah, so I can take a stab at the second part of that question. So BRP has a culture of innovation that's rooted through both the management all the way down. The management has been part of power sports for their entire tenure. A lot of them worked their way up from the bottom of the company. And when we look at their biggest competitor, Polaris, they've historically actually had issues in 2016 to 2019 with a lot of recalls and a lot of fire incidents. This actually changed the culture within Polaris to become more conservative when it came to innovation. And speaking to a lot of dealers, one of the major factors we found in consumer switching brands is the issue of product quality and recalls. So after this incident between 2016 and 2019, BRP continued to scale back their innovation to avoid losing continuous market share because of this purpose.
And yeah, so touch on your second point about the beta. So we looked at the peer beta and we took a weighted average between their closest competitors and other businesses in similar industries that trade with the same cyclicality. And so we took their lever beta, which we got as 1.4, and then we unlevered it and we got 1.1 there. And we compared this to be conservative to the actual beta we have with the TSX, which is where which BRP trades, and that was 2.25. And we felt that was not reflective of BRP's actual core beta because the TSX is a very small and illiquid market, which did not completely reflect BRP itself. And this is more in line, the levered beta, what we see here is more in line with the BRP's data is on the NASDAQ.
What would you say is the biggest strategic risk to your thesis?
So we would say that the biggest strategic risk to our thesis is their balance sheet risk. So to give a bit more background, given the fact that the company has underperformed in the past year, their leverage ratio is now higher than their target at around 3.2 times. Additionally, they had higher inventory because a lot of the buyers that were in the business during COVID that maybe weren't going to replace their product because they just bought the product one time to explore trails when you needed to socially distance, those people are not coming back. So they had higher inventory, which led to higher write-downs. However, to maybe discuss those individually, their leverage ratio is below the peer average, and we're not concerned about this because they have no covenants on their debt. Additionally, they received, we estimate, $200 million from the sale of their marine business, which can be used to further reduce liquidity. On the inventory write-down point, they have significantly lower inventory than their biggest peers, and their write-downs are currently at their lowest level in 3 years. And so we're really confident that they'll be able to continue doing this, and this presents a strong entry point for the business.
Okay. Yes. I'm just wondering, based on all the numbers you're presenting, they seem to be doing much better than their peers across in terms of even inventory, their margins, their leverage ratios. So why are they still at a discount to the market?
Yeah. So we believe the discount in the multiple compared to peers, the first is because of tariff and destocking risk, but the second part we believe is because there is a liquidity discount in the stock because of the dual class ownership. So the three entities, Bain Capital, CDPQ, and the family collectively own 54% of the shares outstanding, control 86% of the voting power, leaving a public float of 46%. And we believe that this liquidity discount, as calculated by bid-ask spreads and liquidity turnover ratios, show that BRP has a lower liquidity than peers, attracting lower institutional investment and thus creating a discount that results in the stock trading a bit lower than peers.
Have you incorporated that liquidity risk to the cost of equity that you're using to discount the cash flows?
No, we haven't incorporated it, but we believe that the exit multiple, which is 7.5 times, is still lower than the peer average in terms of mid-cycle multiples. And we believe that the dual class risk is mitigated through strong alignment with the three shareholders. So we believe the family group and Bain Capital both have board seats. They hold 5 out of 11 board representations. And they have a vested interest in the stock and have been with the company for the last 20 years with a strong track record of a 75% 10-year return, while Polaris has declined by the same amount.
But the ownership is not new, right? The ownership structure has not changed. Is that correct?
Yes, that's correct.
Regarding ESG, could you talk a little bit more about your proprietary scorecard and why didn't you use other public
Yeah. So we made a proprietary scorecard because we actually spoke with an individual who studies businesses and studies their ESG scores. And what he told us is that a lot of these scores that are put out by other companies can sometimes be very different because they have different criteria. So, for example, when we looked at one rating agency, they had BRP as their highest rated business of their peer set, and another rating agency had it as their lowest in their peer set. So, to try to standardize it, we created our own scorecard where we see that BRP trades roughly in line with their peers, which makes it not a drag to their valuation.
So what you are saying that you did a better job than the companies outside.
No, absolutely not. If we followed the market, it would have been really easy for us to stand up here and say that we only selected the company that put BRP as their highest rated.
Time.
So, thank you very much.
Thank you.
Origin, Australia's leading integrated energy company, is powering through market volatility as a structurally resilient business. With a clear path ahead to light off shareholder returns, we issue a buy recommendation based on a 12-month price target of $11.84, a 16.4% premium to the 1-month VWAP.
Origin is Australia's energy provider of choice, with a vertically integrated 3-segment model as an energy generator and retailer, consisting of 1, the internal energy market operations across electricity and natural gas, 2, APLNG, an upstream LNG producer, and 3, Octopus, a UK-based software-driven electricity retailer. Operational and geographical diversification is the power source behind Origin's story, with an expansive generation fleet that delivers 7.8 gigawatts of energy to the homes of 4.7 million customers today. This diversification has brought advantages in the form of strategic fleet distribution and flexible output capacity, which have powered Origin to the top as the leading energy giant of Australia. And in the long run, we see that Origin's lead will endure, with growing future demand driven by tech advancements including energy-intensive data centers and the movement to electrification and renewable energy.
Increased demand, however, will drive further volatility in an already constrained Australian energy market. There is a supply constraint challenge in the Australian energy market, with 17 gigawatts of shortages in the renewable space, exacerbated by 5 gigawatts of shortages in the coal-powered space. Yet Origin is structurally well placed to deal with this for 2 key reasons. First, the timing of Origin's renewable fleet is far better prepared than their peers to meet this risk. And second, Origin's cost of revenue is 12.7% lower than their closest peer, indicating a structural cost advantage moving forward. Despite these advantages, however, Origin has fallen to trade at a multiple below the industry median, indicating a material undervaluation. And hence, we issue a buy recommendation, underpinned by 1, Origin's portfolio flexibility, which allows them to challenge the supply constraints, 2, cash flow stability generated by APLNG, and 3, growth energized by Kraken, ultimately enabling Origin to power through an era of global uncertainty.
The flexibility of Origin's energy supply portfolio and capex-light focus will offer insulation against the volatile market. Australia's energy market is now the most volatile globally, with forecast renewable shortfall and understated brownout risks. From these extremities, the market has mispriced Origin's superior positioning, driven by 1, its industry-leading firming capacity with gas peaking plants and an unrivaled virtual power plant, and 2, the timing alignment of batteries coming online to its Eraring coal plant closure, differentiating Origin from its main duopolistic rival AGL, with their pipeline mainly yet to be approved. This portfolio advantage will lead to reduced expensive spot market reliance and capture mid-transition arbitrage during peak demand. We forecast these portfolio advantages to increase TAM share up to 22%, boosting top-line EM growth and a 5% uplift in value. Besides output capacity, flexibility is also recognized in the balance sheet through a disciplined capital-light focus. Across recent battery developments, Origin's offtake deals with infrastructure partners achieves a capital-light strategy due to lower capex constraints. This has led to Origin's proven ability to beat capex consensus by on average 18%, representing unwarranted grouping to capital-intensive peers. With a capex to sales of 3.2%, there is material mispricing of long-term efficiencies. Shining over peers, we forecast competitive PPAs to drive returns and a 2% ROIC uplift.
Second, Origin is powered by the cash flow stability delivered by APLNG, energizing them through an era of global uncertainty. First, Origin has long-term, fixed contracts for the sale of APLNG, which will ensure stable revenues throughout the forecast horizon. With 95.6% of their annual production structured into take-or-pay contracts with Sinopec and Kansai, this guarantees over $25 billion in revenue over the forecast horizon. The certainty of this revenue is supported by 1. Minimal counterparty risk, as Sinopec and Kansai are state-owned entities, but 2. Origin's strong reserve position. With market-leading reserves on the east coast of Australia, Origin is well prepared to not only fulfill this contract, but additionally to dominate the gas market moving forward. Second, supply-demand imbalances both domestically and internationally are set to drive up LNG pricing and therefore LNG revenue. Domestically, demand is set to exceed supply as soon as FY29, yet this will drive up domestic price of LNG near the international netback price and boost Origin's domestic LNG revenue by as much as 5.8%. Whilst internationally, particularly in Southeast Asia, declining production from key powerhouses such as Indonesia and Malaysia, as well as the adoption of gas from coal to gas switching, will drive up the adoption of Australian LNG. With APLNG's favorable geographic positioning in this region, APLNG is set to deliver Origin over $9 billion in free cash flow, which they can utilize to stabilize in a period of immense global uncertainty.
Third, Origin's 22.7% stake of Octopus Energy contributes 25% to its valuation, driven by Octopus's dominant position in the UK market and its ongoing international expansion. Origin also benefits from strategic integrations with Octopus's successful traits, which enhances its competitive positioning in a volatile market. In 1, delivering exceptional customer service, as seen in its NPS margin. 2, harnessing network effects. And 3, optimizing cost efficiencies. These growth opportunities within a structurally mature industry remains underappreciated, resulting in a forecasted 1.9% lift in Origin's market share. Next, Origin is cracking down on costs. Origin's proprietary ownership of Kraken technology is unmatched and is expected to reduce 1. Network costs through grid optimization, which is key given the energy market's volatility, and 2. Cost to serve via automation. We forecast that these costs will fall below consensus as Kraken was only recently fully integrated after management delays. As indicated by our proprietary survey, these lower costs will enable Origin to price more competitively, which is the main factor in reducing churn and replicating Octopus's successful customer stickiness model.
Origin continues to supercharge its customer network with a powerful triple bottom line. Origin has become a power player in the industry by illuminating a transparent path to a sustainable future. Origin's latest actions have shown transparency behind its plan to switch from carbon-based energy to renewables, with the confirmed closure of its Eraring coal power plant, along with $1.5 billion worth of investments in battery, solar, and wind projects, altogether yielding confidence towards its 2050 goal for a net zero emissions profile. We foresee that this action plan will spark positive MSCI and Sustainalytics re-ratings that will bolster its relative ESG position, as we see that future ESG scores of utility companies are expected to prioritize renewable production. Flexibility in Origin's operations has been reflected into its service becoming reliable and affordable. With the rising adoption of Origin's Power On program, Origin's customer network is set to be insulated from the cost of living crisis inflicted by recent global economic tariff activity, with customer happiness index growing at 14%, which further supports our MSCI re-rating. Origin's plans continue to be executed by an astute internal team having the relatively highest level of diversity and experience over the last 3 years. With a powerful remuneration system pivoted around shareholder value, there's extreme conviction that Origin's governance team will supercharge their social mandate and ensure substantial improvement to their net promoter score.
The origin of our buy recommendation is a robust, multifaceted valuation. Our relative valuation utilized enterprise value multiples to value each of Origin's 3 segments to separate suitable peer sets, which were added together to arrive at a target price of $11.44, implying an EV to EBIT multiple of 13x. With Origin currently trading at 11.3 times EBIT, we expect Origin's strong competitive position to drive value uplift and re-rate towards peer multiples. Our intrinsic valuation reinforces our expectation that Origin should trade at and above peers with an implied price of $12.01. This was derived from a granular, bottoms-up discounted cash flow model where we forecasted all key idiosyncratic revenue and cost drivers across energy markets, APLNG, and Octopus. Together, we use a blended valuation, weighting intrinsic 70% and relative 30% to arrive at a target price of $11.84. We believe this target price is robust. Our Monte Carlo simulation model indicates that our buy recommendation holds true in 88% of the 100,000 simulated cases. We even utilized a reverse DCF model, which indicates that historical free cash flow growth outpaces market implied forward growth by 2 to 3 times. demonstrating the market's underestimation of Origin's proven ability to grow free cash flow. However, this era of volatility presents 5 key risks, two of which we consider most significant. Notably, a shifting electricity supply mix underpins Origin's future reliance on bought generation, with these costs vulnerable to exogenous forces. However, Origin is expanding supply from favorably priced PPAs from its development pipeline to mitigate cost pressures. Furthermore, the government subsidization scheme for 9 gigawatts of clean firming capacity development threatens the competitive edge of Origin's own firming capacity and puts downward pressure on peak wholesale prices. However, with the proposal to include gas in the scheme, Origin can benefit from the scheme and reduce its costs.
Origin is unrivaled in the volatile energy transition through 1. Its flexible energy supply portfolio, bolstered by 2. APLNG cash flow stability, and 3. Leveraging unique octopus growth. Now, a brighter path ahead has been sparked, and it's only up from here. This is just the Origin.
Again, wonderful presentation. I have a question. Why do you think the company is trading at 11.3 versus the industry, which is at 14.6? Given, especially, you mentioned that the costs are lower and the growth potentially will be higher with the acquisition and the potential that you see in Kraken. Why is trading that low?
I'm happy to take this question. If we go to slide A4, we can look at the share price history of Origin. And what we see as events which catalyze negative ratings of Origin is effectively the fact that there have been negative announcements by management around APLNG, their LNG side business, because the crude oil price has fallen to $60 a barrel. And given that the contracts correlate the price of crude or the LNG to crude oil, this news combined with news that LNG is struggling to meet production targets has resulted in their share price trading low. The reason that we think this will not continue into the future is threefold. The first is, through discussions with management and through discussions with experts, we've learned that Origin has a robust hedging strategy, and our analysis affirms this. If you go to slide I7, we can see that they not only have 4x hedges, but they also have hedges for the pricing of LNG that are all in the money. And this means that any short-term fall will still be mitigated by trading revenue. The second is Origin has a natural hedge into the long term, which is even if the market reacts negatively to the price of oil falling, that means the cost of inputs for their energy market segment stay low, because that means that they can use oil in their LNG in their energy market segment for a cheaper cost, and as a result, this is particularly effective. The final reason we think, however, that will re-rate into the long term is we have done some analysis on slide C11, excuse me, on effectively the long-term production of APLNG. And what would C12, sorry. And what we effectively determined is that all of them have been short constraints in the historical basis because of the fact that effectively there have been block-ups and effectively pile-ups at their filtering facility for LNG, excuse me. These filter-ups have actually started to reduce. And as a result, in the long term, we expect them to work at full production and as a result, meet production targets moving forward.
Given how volatile crude prices usually are, how did you forecast your DCF revenue expectations in the long term?
If I can take you to APLNG profitability, we can see that naturally as reserves decline, that we see sales volume decline. However, in the long run, we see oil prices, we have maintained a long run target of $60. However, given Origin has hedged against oil, we see that we have capped near-term oil prices at $76 a barrel, given that is the swap amount. And so in that sense, we have taken a conservative estimate in assuming that it decreases in the long run $60 a barrel.
Additionally, the way that the contract works is Sinopec, the counterparty, and Origin, who is the original party, have a mandated contractual agreement where they can renegotiate prices on an annual basis. And the mechanism which has traditionally worked is that if oil prices have fallen, the slope has increased. So the slope referring to the percentage of the oil price that LNG is sold at. The slope has actually increased to compensate for that. So that can be evidence in how Sinopec, for example, negotiated a price decrease when the oil price was at $76 a barrel, but given that Origin can exercise this again in August, we believe it's likely they'll do that now that it's $60 a barrel and set the slope not at 14%, which is the historical norm, but they might set it at 17 to 18%, which is what we saw when oil prices traded at $60 a barrel recently.
I have another question. And maybe someone that has not responded could respond to that one. Could you talk a little bit more about the purchase agreements that you mentioned that are concentrated in two big government clients, I guess?
This is the LNG for the LNG market. Or for the LNG business.
Yep, happy to take that. If I could turn with you to the main slide.
Yeah. So what we can see is, speaking about the two agreements, they are long-term agreements that expire in CY35 and CY36. And ultimately what these means is that these are agreements towards the price that is being negotiated for LNG. And the reason why we believe in the stability of this is that it makes up 95.6% of the total revenue that is earned from this division, and therefore ensures stability over the long run. And noting the volatility of the oil industry as well as the energy and utilities industry, this is what is crucial as a solution to that, and hence provides stability for stakeholders in general in terms of the contract.
And what could be the risk of that? Because I mean, it's 96%, it's concentrated in two clients.
Well, firstly, I can perhaps point to Sinopec, which is the single largest client of LNG from APLNG. Sinopec is actually a joint venture owner in that joint venture, and therefore they have a vested interest, and they have essentially bought an equity stake such that they see themselves having LNG delivered to them in the long run. And we think that with these clients based in China and Japan, where LNG demand is quite high, given those transition to renewables and the need for firming capacity, we see these contracts being able to be renewed in the long run beyond even our forecast horizon.
Okay. One question. So I believe you did a Monte Carlo simulation. So can you maybe tell me what variables you used as, the random variables, if you will, to run the Monte Carlo simulation? That's the first question. And second question, it seems price of LNG and price of oil does impact the profitability of the company quite a bit. How much does like a 1% increase in LNG price or oil price impact the profitability of the firm right as of now?
Sure. If I can take you to F22, perhaps I'll address the first part of your question, focusing on the Monte Carlo analysis. So we looked at the most sensitive inputs in our model. Now, given terminal value comprises approximately 65% of our total value, we have used final year inputs in unit electricity revenue, electricity TAM, and APLNG total production volume, including natural gas and depreciation. Given these are final year, they affect terminal value, and these are also the largest drivers of value in Origin. And we have looked at the standard deviation using historical values, but then added a margin of safety such that we can test the robustness of our model. And we have found that our buy recommendation holds true in 88% of the 100,000 cases that we simulated.
And I'm happy to take your second part of the question, Marcus, if we could slide to K5 on Trump's tariffs. We've noticed that following OPEC announcements as well as Trump's tariffs, it's led to a considerable decline in the price of oil, which we understand is significant to our valuation. However, there are two main things I would like to allude on this slide. Firstly, most of Origin's earnings are actually in a natural hedge because most of their earnings are in the electricity markets division. What this means is that given the price of oil falls, it results in lower costs for Origin. And secondly, they also have an actual hedge, as my peers have already mentioned, where it's hedged against the JKM and the JCC index. That's US $76 a barrel. And what we can see the valuation impact, to answer your question, is if the price of oil even falls to an average price of $55, which is a very significant bear case scenario, we still uphold our buy recommendation. And as you can see on the graph on the top right, Origin has the lowest exposure to oil price falls because of its natural hedges and compared to its APAC peers.
Strategically, if there was one thing you could advise this management team to do, what would you want them to change?
Yep, happy to cover this through. If we could please go through to E9. So just to describe a bit of context first in terms of the management team, and then moving on to your question in terms of what they can do differently.
to speak about the management team, they have a very high level of experience and diversity, as I covered earlier. Their team is mainly spearheaded by their current CEO, who's Frank Calabria, which has 7 years and 10 months as a CEO tenure, along with a wide variety of different directors across the board who also have a wide variety of experiences that have contributed to the industry. But really speaking to maybe the negatives or the risks that may come about when you have someone who's leading the industry for a very long time, is sometimes when it comes to technological improvements or different sorts of trends that appear upon the board, it's sometimes maybe a struggle to immediately capture it and stick to more traditional methods. So to really speak about an example, Marcus, if you could please flick to slide K3. So to talk about an example, one of the trends we've discussed is how hydrogen production is becoming a big demanded feature in the industry. But what Origin has done recently due to costs is that they've pulled out of their recent hydrogen project, which was the Hunter Valley Hydrogen Hub. And what this means is mainly because of a reduced number of costs the high number of costs that really came about in terms of starting this project. But what this might mean though is maybe a slower transition towards environmental sustainability. But nonetheless, despite the different and other initiatives, including investments in battery projects, there's still a maintained direction. But nonetheless, this is maybe an example of how maybe having traditional methods towards cost rather than environmental sustainability might hinder that transition capability for Goldman.
So I could add on to my colleague's comment. If you could please go to slide B7, we also see that Origin's management team have enacted on a new strategic direction where they intake a capital light approach. And through this approach, they maintain the full ownership initial benefits of determining key geographic locations and having all those initial ownership control benefits, then releasing capex burdens post taking off the balance sheet, and through this allowing them to release those cash flows that allow them to intake into new technological investments and new renewable resources as the market transitions towards renewables and in this volatile transition period.
One question on ESG. So, you mentioned that they rank AA on MSCI and medium risk on Morningstar Sustainalytics. And as an energy/utilities firm, I think AA in MSCI is quite a respectable one. What are the other room for improvement from when you see these reports? What are the other areas of improvement do they mention when they measure when they come up with these rankings?
Yep, happy to take that. If we could turn you to slide E2, which talks about our forecast index scorecard. So to give a bit of a current context, they currently have a score of 6 in environment, 6.5 in social, and 9 in governance. However, over the forecast, we really see an improvement across environmental and social. To start with environment, the way we see this is primarily through their plan to swap from the main coal power source, which is Iranian coal power plant, which makes up 35% of their entire emissions, which they're aiming to close completely in FY27, and hence reduces significantly the amount of emissions, but at the same time have significant investments in multiple different projects, such as the Yanko Wind Delta Farm, along with other battery projects as well, which has really boosted their whole renewable supply. And that's what's really been remarkable in the environmental space, especially because most of the other competitors, such as AGL and others, as my partner has alluded to, have not yet had their pipeline approved yet. And hence that is why Origin has that first mover advantage to get through the transition. The second point coming to social is mainly as we are entering a very volatile phase, as my partner alluded to, in terms of tariffs and price volatility. What Origin has done is included different programs that have involved price affordability, such as the Power On program. And what this has done is ultimately helped them price very competitively below the tariff rate of DMOs as well as other companies. And this is going to be very, very crucial. As indicated by a proprietary survey, price is the main factor behind why customers stick with an energy provider. And hence that is why this will see an increase as well. And governance stays stable as they're continuing to keep their highly experienced and highly diverse team.
And just to add on to the question about what they can specifically improve, if you could go to the Araring slide, we actually had the privilege of speaking to management, and they indicated that they are transitioning away from coal. However, we are very skeptical and engaged in a deeper level of analysis when they say how fast they're going to transition. So we did also notice that they delayed their Araring closure because of the New South Wales government. So one risk that we could face is that if that transition gets slightly more delayed, that would be another ESG risk on it. So yeah.
What would you think is the biggest long-term risk to the company? And specifically, do you think if the Alaska LNG project really goes live, and relationship between the U.S. and China improves, do you think that can be a long-term risk to the company as well?
Allow me to first tackle the second part of the question on the Alaskan LNG impact. If we please go to the slide of, I believe, C7 or C8, excuse me. What we foresee is in our model, we have already actually baked in a huge increase in LNG production, particularly from Qatar and also Alaska. But the reason why we think this will not have a material impact upon origin is twofold. The first is if we go to the next slide, what we observe, just go back to the previous slide. What we can observe is that because APLNG is so much more geographically proximate to Southeast Asia, which we view as a really strong market for growth, this reduces the transportation costs. So whilst it could be cheaper to potentially produce in Alaska, the fact that they have to travel further means it's more difficult. And LNG from Europe is struggling because of the Red Sea troubles. And as a result, we think it's unlikely to really have a play in that sense, which is why we don't think it has a material impact.
Can you talk about the investment in Octopus and how you strategically, why do they own it, and then also how you included that in your valuation? You said it represented, I think, 25% of the value.
Yeah, I'm happy to first tackle the valuation and then why it was benefited. Marcus, if we could go to the relative valuation slide on H3. Yeah, so we valued on a sum of the parts because we think it's more beneficial. And from that, we could derive an Octopus valuation that represents about 23-25% of the valuation. We use two main multiples for SE time.
Okay.
What happens when a company takes a hard look at itself and completely resets? For Honeywell, it's been transformative. Good afternoon. I'm Kira Andrews, joined by Brendan Wortman, Carson Bean, Jack Farquette, and Davis Varr. We're initiating coverage with a buy rating and a one-year target price of $223, representing a 9% upside from May 1st, 2025. With continuous portfolio optimization, reinvestment into future growth, and a commitment to returning shareholder value, Honeywell presents a compelling buying opportunity.
On June 1st, 2023, Vimal Kapoor became Honeywell's CEO, bringing a clear vision for the company's future. Under his leadership, Honeywell's prioritized three key megatrends: the future aviation, automation, and energy transition. As a result, the company has reorganized into 4 business units. The first of these business units is Aerospace Technologies, their largest and fastest growing unit, making up over 40% of Honeywell's revenue in 2024. It excels in aircraft maintenance and advanced aviation technology.
The aerospace industry is characterized by technological advancement, significant capital investment, and a complex supply chain. With estimates of world plane fleets expected to grow more than double, and the aerospace industry slowly gaining defense contract share.
Honeywell's industrial automation unit makes up over 30% of revenue and focuses on warehouse automation and productivity tools. Its building automation unit makes up 16% of revenue and focuses on efficiency, offering integrated management solutions for buildings.
The automation industry is characterized by technological advancements that drive significant R&D investment, intensifying competition, and creating high barriers to entry. With the Internet of Things, AI, machine learning, and advanced robotics transforming the landscape. With IoT devices expected to reach 40 billion by 2030, and AI projected to significantly boost productivity.
Honeywell's Energy and Sustainability Solutions unit makes up 17% of revenue and focuses on cleaner energy. The company produces specialty chemicals while refining crude oil and offering carbon capture solutions, benefiting from being the largest installed base in the industry.
The energy solutions industry is rapidly evolving to meet global demands, with innovative sustainable solutions like renewable energy efficiency improvements, carbon capture technologies, and advanced storage systems. As more companies commit to carbon neutrality, we expect for these companies to capitalize off these commitments. In addition to identifying Honeywell's closest peers in each industry based on products, operations, and services, we also identified Honeywell's conglomerate-like peers based on size, structure, and product offerings.
Honeywell is firing on all cylinders. With a strong financial position and a strategy built for long-term growth, its return on equity has averaged 31% over the last 5 years. While deleveraging may slightly reduce ROE, Honeywell's returns remain solid, consistently outperforming all competitor peer groups. The real game changer? A shift toward higher margin services driving profitability. Since 2018, service revenue has grown from 21% to 31% of total sales, and we project by 2028 it will grow to 37%. Higher margin services and efficiency gains position Honeywell ahead of competitors, and our forecasts indicate that net profit margins will go from 15% in 2024 to 17% by 2028. Honeywell is optimizing operations, cutting its factory footprint in half while boosting efficiency. Although inventory turnover trails competitors, fixed asset turnover surpasses many, demonstrating Honeywell's ability to extract more value from its resources. On the capital side, Honeywell's debt is up 56% since 2023 to $26 billion. While this brings its debt ratio to 64%, its strong credit rating and high interest coverage indicate it can effectively manage this leverage.
Through our ESG risk assessment, we concluded the company maintains an overall average risk score, but ranks top 10% in its industry for risk mitigation. Honeywell is minimizing its environmental impact through greenhouse gas intensity reduction, as well as advancing its CO2 reducing Solstice product line. Additionally, the company surpassed its 2024 targets, doubling its goals for emission reduction, renewable energy deployment, and achieving energy management standards. The company is dedicated to social responsibility through its diverse workforce, community outreach, and workplace safety. Despite operating in the high-risk defense industry, Honeywell engages with stakeholders to address concerns and maintain ethical business practices. Its diverse board of directors provides strong governance and qualified leadership expertise with 83% independence. The CEO's compensation is 91% variable mix, ensuring executive incentives are strongly aligned with company success. Additionally, our evaluation of managerial entrenchment revealed Honeywell upholds robust shareholder rights.
Honeywell's growth will be driven by three key tailwinds: strategic portfolio management, innovative technologies, and reinvesting strong returns. After pressure from Elliott Management, Honeywell's decided to separate into three distinct companies: Honeywell Aerospace, Honeywell Automation, and Advanced Materials. With a strong track record with spinoffs, the company is well positioned for this transformation. At the same time, the company is aggressively expanding through acquisitions, hitting over $10 billion in deals in 2024. These acquisitions have already brought over $800 million to revenue. Honeywell is also strengthening its presence in high-growth regions like India, further diversifying its portfolio. With India's projected GDP growth rate at over 6% annually over the next 5 years, the country presents a significant growth opportunity. India's aviation sector boasts a 12% CAGR with over 1,200 aircraft on order. Meanwhile, Honeywell continues to lead India's automation sector and is actively advancing projects to capitalize on its 14% growth. By 2026, Honeywell aims to generate over 25% of all revenue from India and other high-growth regions, further reinforcing its global expansion strategy.
Honeywell is also driving growth through software innovation. Since 2019, Honeywell's Connected Enterprise segment has achieved a remarkable 16% CAGR, fueled by the rising adoption of software as a service and subscription models. With Honeywell hardware in over 100 million buildings and 90% of global aircraft, the company is unlocking additional value by integrating add-on software through recurring revenue streams. AI innovation is central to this growth, powered by Forge, Honeywell's IoT platform, which connects with over 100 million assets and generates revenue through subscriptions, licensing, and support services. This data advantage and integration reinforces Honeywell's leadership at the forefront of IoT-enabled, AI-driven solutions. Looking ahead, Honeywell's Quantinuum, the world's largest quantum computing firm, is developing quantum software to help train AI models. Strategic partnerships with leading tech firms highlight the commercial viability of these products, reinforcing Honeywell's leadership at the forefront of next-generation technologies.
Honeywell has consistently delivered strong financial performance, maintaining an average free cash flow to EBITDA ratio of 58% over the last 5 years. This highlights the company's ability to convert earnings into cash, supporting continued capital deployment. With revised projections now estimating up to $40 billion in capital deployment between 2023 and 2025, largely allocated towards acquisitions, Honeywell is well positioned to drive further growth. The company's return on invested capital has outpaced its WACC by 7% on average over the last 5 years, demonstrating Honeywell's ability to generate attractive returns on investments. In addition to expansion, Honeywell remains committed to long-term shareholder value, proven by 15 dividend increases in the last 14 years and a 17% share count reduction since 2017.
To reach our 12-month target price of $223, we develop a weighted average scenario analysis using a DCF analysis with both an EV to EBITDA exit multiple and perpetual growth rate approach, as well as PE and EV to EBITDA relative valuations and a sum of the parts valuation. Combined with the projected 2.1% dividend yield implies an 11% total return. In our base case, we expect service revenue growth to outpace product revenue growth, coupled with stable aerospace growth in 2025, driving a 6.4% CAGR over a forecast period. Margins are projected to rise from 38% in 2024 to 42% in 2028, supported by portfolio optimization, a shift toward higher margin service revenue, and Honeywell's recurring revenue model. Our DCF analysis incorporates an EV to EBITDA of 15 times, in line with industrial conglomerate peers, and a perpetual growth rate of 3.5%, consistent with the multiple. Our relative valuations apply a PE of 23 times and an EV to EBITDA of 16 times, lower than Honeywell's current and 3-year average multiples. While they are below the 3-year average multiples of many of its industrial conglomerate peers, they are below many of the 3-year averages of Honeywell segment-specific peers. With Honeywell's conglomerate structure, we also develop a sum of the parts valuation to offset value suppression.
We individually value the aerospace, automation, and energy solutions business units using segment-specific EV to EBITDA multiples, as well as segment profitability and investment assumptions. This yields an implied 16.6 times EV to EBITDA multiple. Our recommendation is robust using more conservative growth rates, margins, and multiples. We also incorporated a post-Liberation Day steady-state case and potential downturn case. We believe that our conservative valuation framework presents upside potential with limited downside risk.
As the company navigates various risks, it implements mitigation strategies to maintain stability and future growth. Its global supply chain faces disruptions that could affect costs, production, and profitability, though its diverse material and supplier sources reduce potential negative impacts. A potential recession could impact demand and operations, though each segment is strategically positioned to defend against downturns. Expansion into high-growth regions like India is inherently risky, though the company already has an established global presence, reducing its movement risk. We reiterate our buy recommendation for Honeywell with a $223 target price, representing a 9% upside and a total return of 11%. Portfolio optimization, reinvestment into future growth, and strong commitment to returning shareholder value makes Honeywell a compelling investment. Thank you.
I've seen many teams that match the tie, but I've never seen a team that matches the shoes. Congratulations for that. I have one question. I mean, I've never seen a forecast that doesn't go up. And in your case, I was looking at your margins. The current margin in 2028 is 14.8. I don't remember how many years you have in the history, but in all the years, it ranges from 16.1 to 14.0. And on the years in the forecast, all the numbers of all the margins are much higher. Why should I believe that if they have not performed in the past? Why that big increase?
I don't know.
One sec. Yeah, so one of the reasons we believe their margins are going to continue to increase so rapidly, 172, please. That's not working. Is because of their product and services. So Honeywell has made the decision to start shifting heavily towards strategy, or made the strategy decision to start shifting towards margins, which we believe will increase their margins overall since there's a lot less cost of goods involved. Okay, thank you. So we've seen this trend already happening across all of their separate business units, and we believe it's going to continue in the future, which will overall increase their margins as they shift from services to products.
From products to services. Sorry about that.
Sorry.
In terms of just the impact of, it seems like there is some impact of decline in travel, or what would it be on them in terms of how their revenue correlates to actual travel going forward? Because it seems like people are certainly cutting their international travel at this point.
I can start this off. So the Honeywell actually makes most of their revenue through services with existing planes already in the motion. So as travel decreases, these airliners still have to service their planes for operation, no matter if they're flying less or more. So this is where Honeywell can benefit from this, as well as their government contract backlog, which is an all-time record.
If you go to the next slide, we can show you the actual backlog. Their backlog has actually grown 8% year over year, and 15.67 billion of this backlog is in the aerospace. So we're really confident in this growth and the future of the backlogs.
And what's their exposure to Boeing?
Yeah, can you go to the slide? It's on this slide. So the last thing. Yeah, so Boeing has decided to switch actually to doing in-house navigation and avionics equipment, which is one of Honeywell's largest platforms. However, Honeywell has extensive contracts with other areas like auxiliary power units. So as Boeing tries to switch into their own in-house navigation and avionics, Honeywell is still part of that business line in their more crucial segments like the auxiliary power units, which so a plane goes down, these power units will help them to maintain flight stability. So although Boeing might have had negative impacts recently, they are still exposed on the continued products, which has been lessened due to Boeing doing some of this in-house.
Do you think they are exposed to the potential changes in tariffs? And if so, how?
Yeah, tariffs were definitely a prime conversation and something that we considered. We looked historically at how the company handled tariffs starting in 2016, and we found that about 43% of their goods were produced outside of the United States. When these tariffs became of age back in 2016, we realized that the company took a strategic localization strategy.
So this is the local to local strategy. If we go two more slides, so it's just setting up the supply chain and production within countries. Specifically, what we found was a lot of this was happening in China, though they did move out a little bit of manufacturing from China back in 2016 with that first wave that Davis mentioned of the Trump tariffs in his first administration. But in this administration, they have seen only about, if you have the next slide, $500 million impacted, but they also have a really good relationship with China. And that is kind of the biggest worry with the Trump tariffs as of right now. Though in the past couple of days, we have seen progress with a trade deal. But as you can see here, they have a lot of projects with Chinese companies, along with being a part of the China International Import Expo in Shanghai for the last 8 years and still plan to go in November of this year. If you go to the next slide, too. And here you can see that the exposure is minimal. Only 5% of total sales happen in China. So about 500 million or 1.5% of revenue is exposed to the tariffs as right now.
Um, in a chart, you say that the return on equity will peak in 2025 and it'll gradually go down from 31.5% to 27.9% in 2028. And so why should I buy a stock where ROE is, going down? And if you're like an internal analyst or a sell side analyst, what kind of advice can you give to boost up the ROE going forward compared to your expectations?
So the main reason we have ROE declining in the future is because we were more conservative with how much debt they'll be taking out. They have mentioned that they're very capable of taking out more debt. They're not at capacity at all, but we thought it'd be more reasonable since they have quite a bit of cash on their balance sheet at the moment. So it's really the equity multiplier that starts to decrease. And could you repeat the second part of your question? I'm sorry.
What kind of advice can you give to the management in order to boost up the ROE if you're a sell side or an internal analyst?
Yeah, well, the margins I believe are a good one. Like I mentioned before, they've already shifted towards the service strategy over their products. I could see them potentially taking out more debt, which would increase the equity multiplier. I just don't see that as a need for the company at the moment. So I would believe Honeywell is better suited to strategize towards the profits along with the asset turnover.
This was actually the chart that I was referring to, because if you see the net profit margin goes 15.5, 16, 14, 15.4. Right now it's at 14.8, and then everything goes up. No, so sometimes I don't believe those.
Yeah, so you're talking about the 17% for 2028.
Yes, I mean, and also related to valuation, I have a question regarding to your terminal growth rate, because today I've seen growth rates probably 50% or more lower than yours. So could you explain more how you get the 3.5?
Yeah, so we did our DCF valuation, and whenever we did it with the EV to EBITDA, we actually ended up with a 3.96 internal or perpetual growth rate that would be implied by our EV to EBITDA multiple. So we went with a more conservative growth rate of 3.5%. Additionally, we've seen the company actually growing this year in spite of tariffs and the macroeconomic conditions. So we believe that this is reasonable for the company. I'm just trying to pull up the WAC development. Yeah. Having trouble finding the mouse. Um, mm. Oh, sorry about that. So our WAC development, oh, it's different. But yes, so our internal, our implied perpetual growth rate was 3.96
whenever we did our EV to EBITDA valuation. So we believe that using a 3.5% was more conservative for our valuation.
But how can you support that number? No, because at the end of the day, that's like the stable growth rate of the economy.
Right.
How you
We believe that Honeywell is well positioned to capitalize on the aerospace growth that they've been seeing, as well as building automation. So as we see, the tariffs and we see manufacturing coming back to the United States, we believe that Honeywell will be able to capitalize off of this in their building automation segment, which we've already seen in their Q1 earnings, as talked about by management.
Yeah, I mean, with their aerospace growth, I believe that we have lowered their actual growth rate a little bit next year, but they do have really high growth, and we're excited about their aftermarket aviation products. So the maintenance and repairs that are still done on airplanes, that is growing and their biggest segment. So within each segment, we see a lot of growth potential. Uh,
Um, on the slide that shows the asset efficiency, it seems their inventory turnover is going down steadily, whereas in terms of fixed asset turnover, it has improved quite a bit past 5 years. Why do you think improvement in fixed asset turnover is more important than decrease in inventory turnover?
Yeah, so the main reason the fixed assets turnover has been going down is because of the shift to services, like I mentioned. But as far as you asked about the total asset turnover, I believe.
I mean, inventory turnover going down, I believe that's not a good sign. So, and it seems fixed asset turnover, at least has been going up past 5 years. So, um, so let me rephrase the question. Why has the inventory turnover has it been going down? And how can we view that as a positive sign for the company?
Okay, thank you for reiterating. So the main reason their inventory turnover has been increasing is because their aerospace has been growing a lot more compared to the other segments. And aerospace, it's the industry total generally has a higher inventory turnover than compared to automation or energy, like the other segments. And especially as the backlog keeps growing, we see their inventory turnover continue to grow as well.
Can you talk about the acquisitions going forward? Historically, this has been a very acquisitive company. What are you expecting and what do you have in your forecast?
Yeah, could you go one more here, driver one? Yeah, future M&A. So this was a graph taken. So there was 400 executives from mid-cap companies. That said, so 54% of that 400 said that the future outlook of 2025 is going to be probably like the best year in the last 5 years for M&A activity. And actually, Vimal Kapoor, the CEO, has said that they do plan to keep on acquiring companies, especially these bolt-on acquisitions that we've been seeing in the past that are just kind of a way to add to their all-around services. And especially with the future spinoff of the whole company, they are looking for these bolt-ons that can just kind of get up and run with what they're doing already.
When is that spin-off supposed to happen? And is it so they're going to separate into three companies? Did I understand that?
Yeah, they're spinning off late 2026 with advanced materials coming at the end of 2025. But aerospace is gonna and automation are gonna split at the back end of 2026.
And did you incorporate that then into your valuation? How did you do that?
Yes, we incorporated that into our valuation with our sum of the parts valuation. So we individually value the aerospace, automation, and energy solutions business units. And we did that using kind of historical. Let me go to there. So we took the EBIT for the company and then we figured out how much of each segment kind of was allocated toward the EBIT. And then we use the historical depreciation and amortization for each of the segments. And then we use segment specific multiples to find the enterprise value for each of the segments. And then we incorporated this into our valuation. And this was 25% of our target price. So.
I was going to ask about ESG, but you actually cover that topic very well on the slides.
Thank you.
How do their margins compare to the competitors?
Yeah, I think it's that one. So their margins are actually very good. We compared them to the industry averages since they are in 4 different industries. Their conglomerate peers are their most, I would say, their best comparison. And across the board, they do have higher margins than the averages. If you go to the next slide, please. We wanted to do a more specific breakdown of some of their highest competitors, which are 3M, GE, and then Johnson Controls we use. And I believe 3M is the only one that has a higher gross margin in the last 3 years compared to Honeywell. And the main reason for that is because they have one of their conglomerate industries is healthcare, which tends to have higher margins than others.
In the services business, it's growing. You're assuming it's going to continue to grow. Who are they taking market share from there, and what are they doing to gain share?
They're taking market share from other conglomerate competitors, particularly Siemens, 3M, and Johnson Controls, as their Honeywell IoT Forge is the only service of that scale with over 100 million assets connected from their large installed base of 100 million buildings. They're able to take in time.
Okay.
Dear investors, how much do you know about the real estate market in Poland?
Chances are it has flown under your radar, and that is why we flew in from Poland to present you Dom Development, Poland's leading residential real estate developer. We are bullish on the stock, and we are issuing a buy recommendation on this stock with a target price of 272 Polish zlotys. This is 24% upside on the stock from the close of 30th April. Ladies and gentlemen, did you know Poland is one of Europe's fastest growing economies? It is currently experiencing a real estate boom. Check this, prices have doubled in just 6 years. And Dom Development is the company cashing in on this boom. Founded in 1996, Dom Development is a residential developer specializing in multifamily housing. It has delivered over 50,000 units to date, and impressively, the company has a track record of 18 years of dividend payments. Operating in 4 of the 6 biggest housing markets in Poland, Dom Development posted 3 billion PLN in revenue. This is slightly below 1 billion US dollars. Dear investors, we see 3 reasons why Dom is a compelling investment. First, well-positioned to sustain market leadership. Second, there's a structural housing gap which benefits Dom Development in Poland. And third, it has a strong, robust development pipeline. We conducted over 30 interviews with direct customers and competitors of Dom, and now let's delve into its business model.
Dom operates fast. We witnessed that firsthand when we visited one of their construction sites. At the time this picture was taken, over 30% of the site was already sold out despite the early construction stages. This is a result of an integrated business model that relies on strategic land acquisitions with permits and managing construction through a mix of internal general contractors and external subcontractors. This is further strengthened by value-added services like mortgage consulting and turnkey apartments. The key to Dom's success lies in its efficient land and its resilient client base. The company's land bank is capable of supporting a 5-year project pipeline, and its focus on the premium segment gives the company a pricing flexibility that then allows them to manage rising costs.
Now, please think about this. Poland is facing a structural housing gap. Home ownership isn't a financial decision. It's part of culture shaped by the country's history. And yet, Poland continues to have one of the highest overcrowding ratios in Europe. Yes, this is the market that Dom Development operates in. Adding to that, Dom's key cities are expected to grow, defying the national trend. Furthermore, influx of 2 million Ukrainians due to the ongoing war has further accelerated urban migration. So the result of this, a housing market with sustained and urban demand. But wait, demand alone isn't enough. Affordability will be the key. With inflation now cooling down, interest rate cuts in second half of 2025 will unlock purchasing power. On the other hand, our analysis backed by interviews with industry experts, including CEO of Dom's direct competitor, highlight rising costs will squeeze margins. In the meantime, the short-term sentiments on the Polish market also remain mixed. While the new offers from the developers are rising, The slower demand in 2024 has pushed the available offers to a 5-year high across the biggest markets. And yet, the rising construction permit signaled renewed confidence for the future. So the answer, why does DOM thrive in this environment, or how does they thrive in the environment? The answer lies in its strategic landman. What truly sets the company apart is the prime location and quality of its asset. The premium portfolio secures a distinct competitive edge, reinforcing both our first and third investment thesis. But then, strong positioning would mean nothing without execution. Even during challenging 2024, DOM not only outpaced its competitors in sales volume, but speed, once again showcasing its operational excellence. Now, as the market consolidates and the weaker players struggle, DOM is in prime position to benefit from this opportunity, backed by its strong balance sheet and high cash reserve. Now, let's see how all this flows into our financial statements.
DOM Development continues to deliver consistent revenue growth supported by healthy margins. To forecast this trend, we analyzed projects dating back to 2012 and extrapolated construction pipeline, adjusting for pricing dynamics across cities. Profitability is expected to soften gradually due to rising land and operational costs, yet we still believe it will remain at healthy double-digit levels. Nonetheless, strong fundamentals remain intact. Underpriced structural demand drivers like urban overcrowding, rising migration, and improving financing conditions support ongoing sales momentum. These trends allow DOM to partially absorb upcoming cost pressures and maintain a stable growth path even in a changing macroeconomic environment. This resilient performance is underpinned by DOM's disciplined financial management. Company's low net debt levels and stable cash reserves protect against volatility, giving it a reliable foundation for operation. This strict capital management not only reduces reliance on external financing, but also shields the company from potential economic downturns, allowing it to maintain growth without compromising stability. Additionally, the company presents strong value creation ability. Its consistent dividend growth and top-tier ROE reflect prudent capital allocation and long-term vision. By balancing profitability with a commitment to reward investors, the company has built a track record of delivering attractive and predictable capital returns over time. At the core of this financial strength lies DOM's unmatched operational efficiency. Its market-leading cash conversion cycle allows for quicker project turnover, lower financing needs, and faster investment. In an industry where execution matters, DOM is perfectly positioned to grow sustainably, seizing opportunities as they arise while minimizing risk.
And this is shown perfectly in the growing alignment between DOM's strategy and sustainability. On the environmental side, the company's more than doubled its use of renewable energy, simultaneously decreasing greenhouse gas emissions. This supports company targets and results in an overall better ESG risk score in the region. Socially, DOM designs accessible, livable 15-minute cities. Internally, it leads the sector in employee retention and has above average levels of gender diversity at senior levels. Governance is also evolving. The appointment of an ex-chief ESG officer as the new CEO and the first female CFO signal that ESG priorities are starting to influence leadership at the highest level. That said, there are still gaps. Full life cycle analysis is still pending, ESG-linked KPIs haven't been disclosed, and DOM has yet to adopt green building certifications. So overall, the ESG impact is mixed. However, one area stands out, and it's DOM's regulatory proactiveness. We reflected that in increased SG&A costs, while also recognizing the long-term benefits of regulatory risk mitigation. Now, having considered ESG, let's crunch the numbers.
We value DOM using a 50-50 blended approach of DCF and relative valuation, allowing us to capture both the company's long-term intrinsic value and market perspective. Key factors considered in DCF model include DOM historical project trends, current land bank capacity, and a detailed pipeline projection. We applied a WACC of 9.4%, where our cost of equity includes a 40 basis points premium for DOM's low trading volume, while our cost of debt is a yield to maturity of DOM's bonds. We determined a terminal growth rate of 2.7%. Even with our conservative revenue estimates and a cautious margins assumptions, our DCF analysis shows a 25% upside, leading to a target price of 275 PLN per share. To stress test our valuation, we conducted a sensitivity and a bull and bear case analysis by varying key assumptions. In our bull case, we also assume the issuance of green bonds, leading to a 10 basis points reduction in cost of debt.
We have also considered price to earnings and EV to EBITDA multiples in our valuation. We built two peer sets, local Polish peers and regional European peers based on similar real estate business models. However, for the final price target, we have only considered Polish companies due to specific conditions in Poland. Dear investors, this company is trading at an unjustified discount and presents a strong re-rating potential. DOM Development's based on price to earnings, DOM Development shows a 22% upside, whereas based on EV to EBITDA multiple, it shows a 23% upside. In our sum of the parts valuation model, we have built 3 years of deliveries of the company and have valued them separately. This model also confirms our other valuation methodologies and shows a 22% upside.
Despite our strong recommendation, we have identified three key risks. First, inflation and a sustained trend of high interest rates may weaken residential sales and squeeze developers' margins. Second, uncertainty around new Spatial Planning Act poses an additional government risk. Third, the Ukraine war threatens migration, capital, and labor flows. Dear investors, in Polish dom means home, but to us it stands for dominance, opportunity, and momentum, the core drivers of our buy recommendation. Now, from Team Poland to the world, we open the floor for any questions you may have. Thank you.
Could you comment something more about the interest rates? Because at the end of the day, in real estate and interest rates are highly related.
Thank you for your question. My name is Aniket, and I would be happy to take your question. Jade, if you could move. Okay, the slide is already here. So our assumption about falling interest rates stems from the FRAs. The 6v9 FRAs show that there would be about an interest rate cut of about 100 basis points in the next few months. Additionally, the commentary by the head of National Polish Bank and the monetary chairman suggests that interest rate cuts could come in as soon as May if the inflation remains in control, and the inflation has been falling. So when the interest rates falling down, the demand would be unlocked in the market. Thank you.
I mean, even though tariffs do not apply to you directly, but to Europe it might apply, and that could have an impact on inflation in the future. Do you think that that could have an impact on your pricing, on your valuation?
Sure. So my name is Anastasia. I'll happily take this question. So we considered the impact of tariffs by two things. We first of all looked at the places where DOM sources their materials, and all of them are in Europe, so there's no direct impact of tariffs on DOM's operations. And second of all, we also spoke with DOM's ex-CFO, who also identified the potential broader impact on tariffs on the economic situation in the world. However, we see no direct impact and think that people may still buy flats with DOM as an inflation hedge.
Okay.
I had a question on affordability of the houses. You indicated that there is a significant gap. I was just wondering how that compares to the percentage to the people that can afford the houses themselves. Given that when I look at the chart, it shows the number of units sold have been coming down over the years.
Thank you, Emma, for this question. I would like to bring your attention. So definitely affordability and home affordability is a problem in Europe, but in Poland, the story is different. If you look at the orange line here, you see 11. What this means is the price to income ratio, which means that how many years you need to work to afford an apartment in Poland, is still one of the lowest. So while if you would be in any different European country, the affordability would still suffer, but in Poland it is still one of the best places to afford an apartment. Similarly, you see the price to income ratio. This is another ratio we analyze to understand whether people are better off renting or they're better off owning. And if this ratio is lower, it basically means you are better off. You can afford your own apartment and own your own apartment. And here as well, we see Polish economy and the Poland as a general is more affordable. So this will unlock more demand, and the DOM development is perfectly positioned in this case.
So maybe just a quick follow-up. So how does that explain the decline in the units sold over time?
Okay, I would be happy to take that question. So we saw that in 2023, there was a mortgage program run by Polish government, and that mortgage program offered a 2% subsidy to the buyers. Unfortunately, the program was abruptly ended at the start of 2024, and hence there is a deferred demand in the market where the customers are waiting for interest rates to go down or the mortgage rates or the mortgage program to come up. However, recently the government has clarified that the mortgage program would be coming to a secondary market. So now that the market knows that there is no mortgage program and interest rates would come down, we believe that this demand would be unlocked for the growth.
I have a question on your DCF analysis. So this is a developer which is highly dependent on the state of the economy, and you use beta of 0.6. I'm interested in how you came up with beta of 0.6, and if obviously there's different ways of coming up with beta, but how sensitive is your recommendation or target price with potential change in beta of the stock?
Thank you for this question. My name is Zosha, and I will be happy to answer your question. So basically, to calculate the beta, we conducted 4 different methods of calculation, and we opted for the weekly 5-year regression of DOM versus a VIG index. And basically, it gave us like a number of 0.62, which we believe basically reflects the best the company's position when it comes to the risk profile. It is right now bearing. And when it comes to the sensitivity, how we analyze it, we conducted a sensitivity based on the changes in our revenues and also as well the cost, as well as the WACC and changes in the growth rate.
You mentioned a terminal growth rate, I guess, of 2.7. I mean, many assumptions. I mean, that's an important assumption. Could you support more that information and what impact will have on your price if that is not correct? Actually, you had a table that showed that, but could you develop more on that?
Thank you for this question. So basically, we conducted an analysis and a terminal growth rate was calculated using key value driver formula by multiplying a RONIC of 10% and reinvestment rate of 28%. Based on that, we calculated a terminal growth rate of 2.7%, which is basically roughly about a long-term inflation of the interest rate in Poland of inflation of 2.5%. So it is slightly above 0.2%. Which basically is a really conservative approach. And we also conducted a sensitivity looking at the changes which will affect the growth rate which will come down, but we still believe our terminal growth rate is really low and reflects our conservative approach to the whole DCF and whole the evaluation we conducted for DOM development.
Excellent.
Can you talk about their market share and how they are compared to major competitors?
Okay, thank you for the question. I would happy to take it. When we see about the market share, DOM Development is one of the biggest real estate developers in Poland with about 10% market share. Additionally, we spoke to an industry expert and CEO of DOM who highlighted that in real estate, achieving a 15 to 20% market share is considered a luxury, and very few or no developers in Europe have this market share. So we believe in our forecast period, DOM would slightly expand its market share in the cities that it is growing, including Wrocław and Kraków, and then it will continue to grow with the market. Thank you.
And what about how does it compare to its competitors? How is it positioned?
So if you talk about DOM's positioning in the market, it is placed number 1 in three of the 4 markets that it operates in terms of the sales volume during the last year, and we see that this trend would continue. Now, talking about the competitors are scattered around both bigger markets, including the top 6 cities, and the smaller market. And in this case, DOM gets a clear advantage being in the markets that are expected to grow.
Just to follow up on that, we actually prepared a more visual slide to illustrate how the markets work in our land bank analysis. So we can see that there are competitors of DOM that are actually scattered across many smaller cities, but we can see the key hubs where DOM operates, and these are the most profitable cities with upward population growth rates.
Are there any risk in accessing land in your country? Any regulatory risks? I've seen other cases in other countries where companies used to have a good access to land, but due to changes in regulation, they have done pretty bad.
Sure, thank you for your question. So basically, we see a regulatory risk, which is basically a government risk, through the introduction of new Spatial Planning Act in Poland. Basically, this new Spatial Planning Act will oblige somehow developers to somehow introduce their pyramids and also like the available plots and adjust it to the premise they will be receiving. So basically, the new Spatial Planning Act was announced not so long ago to be set it until the end of this year. However, due to the high challenges when it comes to each municipality to introduce this new Spatial Planning Act, basically there is a risk that this new Spatial Planning Act will be even more prolonged and might also affect the delays in the projects and also somehow close the possibility for new developers to also access the new projects as well.
In terms of competitive landscape, how are they positioned in terms of like their selling price per square feet, or like are they more like a luxury focus or more like mass market? Can you comment on that compared to other competitors, or is it really like a homogeneous market?
Okay, thank you for your question. I would be happy to take that. When we look at the average transaction value of DOM development, it is about 10 to 15% higher than the average market transaction. But it is important to note that they're not a luxury developer. They are in the premium segment, just above the upper standard. And that also shields them in a way to an extent from economic downturns because their buyers are generally wealthy and better off than the average person in the country.
I noticed in your relative valuation, you opted to exclude other European peers. I was just wondering what the rationale was to exclude them and just look at Poland peers.
Sure. Aniket, could you please switch to relative valuation summary? And I can talk about it. Why we excluded them is because we see that a lot of financial differences between European peers and Polish peers. Poland is like a booming economy right now. The price per square meters are booming. Margins are at all-time highs. However, Europe has already passed this phase of big real estate cycle and boom of prices. So valuations are not really comparable, as well as the size of companies were not comparable. We used a specific GPR framework where we were trying to look for developers that really match the growth, profitability, as well as the risk profile. So this specific thing was not found. So we wanted to be more conservative and just use very local Polish peers in the valuation.
Is there any risk of other European developers or global developers entering into the market? Are there any regulations, or could that be a long-term risk for the company? If a major, like a global European competitor enters the market?
Okay, so to look at this, we have seen recent trends in the market where we have seen foreign investors from Germany investing and buying companies in Poland. However, given the market-specific nature of the market of Poland, as well as the know-how of the industry is very important in construction, as well as the permitting process. So in that case, we see that there is a risk, but it could be easily mitigated because the foreign companies would not have the know-how or the expertise or the connections or even contractors to execute projects as effectively as DOM does.
I may add to that. The Polish market is currently having a very large growth in construction and labor costs, which is also an additional barrier to an European competitor entering the market.
What are the main drivers that are helping the growth in Poland, and what are the risks of those disappearing?
So I'll take the first part of the question and maybe my colleagues will follow up. So we identified the structural housing gap as the main driver of demand in Poland, and that is from reports from JLL and McKinsey. The structural housing gap in Poland stems from the fact that Poland used to be a centrally controlled economy. So a lot of the housing stock that's currently available is outdated. People live in overcrowded households. Right now, the average number of rooms per person in Poland is 1.1 as compared to 1.7 in Europe. So we see that there's a lot of room. People are getting higher wages. The economy is growing and they will want to move out to their flats. And on top of that, there's the home ownership rate, which signals that people actually prefer owning their home over renting. So we believe that the new generation of wealthier Poles will be moving out of their houses and buying apartments, which is the key driver in our analysis.
And the risks for that?
To add on to the risk, we see that there is a war going on in Ukraine that could cause, if it spills to the Polish border and extends, there could be an outflow of capital as well as migration outflow from the country. and this could dampen the demand. But the probability of such risk happening is very low, given that Poland is part of strategic alliances like NATO and EU. So we don't see a big negative side in the long-term drivers being slowing down.
And why do you think all those positive things are not reflected in the multiple and it's trading at a discount?
Definitely, yes. Thanks, Rodriguez. If we go to the slide, why the stock is undervalued, there are two major drivers that I'm seeing. First one, let's look at the second one first because that is more important. The market is currently swapping long-term tailwinds with short-term uncertainties. As we talked about mortgage programs, there were mortgage programs that would affect residential developers in the affordable segment. But remember, DOM development operates in a premium segment. So while the market was punishing the developers in the affordable segment, we see that DOM development was unfairly punished and its multiples were trading lower. However, DOM development is resilient to these government policies because it sells to a higher and a more premium client base, which is more affluent. So they don't rely on the mortgage subsidies. So that's the first thing. Market is swapping these short-term uncertainties and punishing DOM. The second thing we see is that market is clearly not seeing that DOM development is ready for yet another record year. For the last 2 years, the company had record number of units sold, and based on current projections, it is definitely going to be another record year if all goes as per plan and without any uncertain risk. The stock is already up 20% year to date, by the way. So you have potential. We see another 20% potential on the stock. So it's not that market is not recognizing. It's just you gotta jump before it's too late.
I think you didn't quite talk about the valuation though that he asked about. Like, why do you think it's undervalued or compared to peers?
Time. Let's talk later.
Okay.
深究 may not be a household name, but chances are you are wearing something they make. As the manufacturer behind giants like Nike and Adidas, Shenzhou quietly dominates the apparel supply chain. So the question is, how could we capture its untapped potential in the world of rising tariffs and shifting geopolitics? Greetings everyone, we are Team Hong Kong U. I'm Adrian and these are my teammates Taeyuk, Kelvin, Huey and Sharon. Today we will set to propose a buy recommendation on Shenzhou. So let's get started. We view Shenzhou as a leader in the OEM market with growth drivers yet to be priced in. We expect Shenzhou to be first, the major beneficiary from bottoming out sports apparel sales, second, lower production costs through ASEAN plant expansion, and thirdly, margin expansion through high sportswear product mix. And why should we buy the share now? Because we observe the market has overpenalized Shenzhou for the tariff impacts, leading to our overall buy recommendation of $65 target price and 27.6% total return, including dividends. I'll now pass the time to Theo to dive into the business.
Shenzhou International is one of the world's largest vertically integrated knitwear manufacturers and a leading exporter of garment products in sportswear, casual wear, and innerwear. It supplies to key global brands such as Nike, Adidas, and Uniqlo, solidifying its position as China's representative in the global apparel industry. It runs a hybrid business model with OEM for garment production and ODM for fabric production, which offers several distinct advantages such as enhanced value chain control, agility and market responsiveness, and stronger client relationships due to the end-to-end solutions that Shenzhou provides. 80% of its revenues come from its key clients, with Uniqlo comprising 80%, that's 30% of its revenue, followed by Nike, Adidas, and Puma. 70% of its revenues come from sportswear, and China remains its largest market, with balanced exposure across Japan, Europe, and the US. Shenzhou competes in the textile innovation space by maintaining three key competitive advantages. Firstly, with the vertically integrated value chain, secondly, with the aggressive overseas expansion, and finally, with the continued investment into digital infrastructure and automation. The most important of which is the vertically integrated value chain. By taking control of the entire production process, Shenzhou is able to lower costs, provide superior quality control, offer faster turnaround, and improve profitability with better pricing power and inventory optimization. Next, we'll move on to the investment thesis.
Thanks, Teok. Our first investment thesis is Shenzhou is the major beneficiary from bottoming out sports apparel sales. As the graph suggests that since the third quarter of 2024, the inventory level among Puma and Adidas had started a restocking cycle, while others have slowed down their destocking activities. While we expect that the global sportswear market can grow at a CAGR of 6% due to rising sports participation rate, we expect Shenzhou to have a sustained top-line growth. Now, I will deep dive into two of its major customers. So firstly, we observed that there's a high correlation between Shenzhou and Nike in terms of stock performance, since Nike was its major customers. And we expect that the management reshuffle should serve as a long-term tailwind, given the new management refocus on the wholesale relationship, a diversified product portfolio, and the aggressive marketing activities. And also, we are optimistic about Adidas' prospect as they recorded a double-digit revenue growth and improving margin in the latest quarter. And moving on to the second thesis, we expect Shenzhou can enjoy a lower production cost through ASEAN plant expansion. Firstly, we see that Shenzhou has successfully shifted its production from China to Vietnam and Cambodia. And we also observe that in terms of monthly minimum wage, the minimum wage in ASEAN countries are 26 to 46% lower than that in China. And given that Shenzhou operates in a labor-intensive industry where wages and salary accounted for a quarter of its revenue, with a diversified production base, it can lower its production costs and lower its operational and geopolitical risk. And now I'll pass the time to Huey to talk about the third thesis.
Thanks, Kelvin. Our third thesis is margin expansion from a higher sportswear product mix. We believe Shenzhou's robust R&D capabilities will allow it to continue to attract new clients, and this is evident as it entered into Lululemon's supply chain back in 2022, which is a premium sportswear brand with higher margin sportswear products. And since then, our estimates suggest that its supplier share had at least tripled, making it now the largest Tier 1 supplier, and this implied their increase in market share. At the same time, we believe Shenzhou is deemed to benefit from the emergence of domestic sportswear brands due to their unique value proposition. And from this graph here, we can see ANTA leading all these domestic sportswear brand names growing at a double-digit CAGR in the past 5 years. And going forward, we expect this domestic demand to remain strong. And with that, domestic clients will increase their revenue contribution to 26% by 2029. So, why should we buy Shenzhou now? As we compare Shenzhou's share price performance with its peers, we notice a significant overpenalization due to the US tariffs. So we see that its recent share price decline of 14% is the largest among its peers, which is almost double of its peer. And however, we see the US revenue exposure of Shenzhou being the lowest with just 16% versus its peer average of 64%. And now moving on to the ESG performance, we see that it is largely in line with its peers. On the social side, we see the improvements in working conditions and also employee welfare have contributed to a lower than average employee turnover rates, as well as enhanced employee productivity. And on the environmental side, we see that the sewage treatment being the most material issue due to the industry's major role in water pollution. And we see Shenzhou as a leader in this aspect, with lowering water consumption intensity through enhanced use of recycled water. All in all speaking, we believe Shenzhou's ESG performance is well up to the industry standard. With that, we therefore reinforce our buy rating for this company. Now I will pass the time to Adrian to talk about our valuation.
Thanks, Huey. I'll now move on to the valuation and projections. We could expect Shenzhou generating sustainable revenue growth from core clients and increasing domestic demand. In terms of revenue, we expect the sales recovery of core clients like Nike and Adidas as mentioned in the first thesis, and also domestic clients like ANTA and Li-Ning in the third thesis act as the key top-line driver. For margins, we forecast a greater revenue in sportswear product mix in near term, by market expansion of clients like Lululemon, as mentioned in the third thesis, driving ASP and margins above consensus. We also expect the overseas cost reduction impacts to kick in, further improving the margins. For our valuation, we adopted a blended valuation approach to value Shenzhou. In our DCF model, we forecast 5-year free cash flow, and based on our WACC assumption of 10.2%, a target price of $65 is derived. And for relative valuation, we could see Shenzhou currently trading at around 11 times PE, which is far below its OEM peers, which is trading at around 16 to 17 times. This leads to our target for PE of 14.8 times and also target EV/EBITDA of 11 times. All in all, this is our key valuation metrics. We adopted DCF for PE and for EBITDA for valuation. And here are our key valuation drivers. Overall speaking, we derive a target price of $65 with 27.6% one-year total return, including a 5% dividend yield of this company. I'll now pass the time to Sharon to move on to the risk and mitigations.
Thanks, Adrian. I will now move on to the risk and mitigations. In terms of market risk, there might be lower than expected demand in knitwear products if customer cuts spending, which will in turn harming Shenzhou's sales and net profit margins. However, since Shenzhou has a strong cash flow and balance sheet, they could actually capture the market gain during industry consolidation. Foreign exchange rates is also significant. Currently, 72% of the group's sales were dominated in foreign currencies. However, Shenzhou could mitigate this risk through buying forward contracts as well as purchase cotton early in the year to lock the cost of goods sold. All in all speaking, Shenzhou has tailored its success and is ready to stage its mark on the market. Let us recap the investment thesis of today. 1. Major beneficiary from bottoming out sports apparel sales. 2. Lower production costs through ASEAN plant expansion. 3. Margin expansion from higher sportswear product mix. And since Shenzhou is overpenalized by the market due to the tariff impact, we see a solid 27.6 one-year total return at 65.2 Hong Kong dollar in the next year. Thank you. I will now open the floor to questions.
Thank you. I have one question. I'm not sure if really the market is over penalizing the stock, because the reality and what we've seen in the market is that the Trump's tariffs have targeted China, and many companies have started to diversify away from China, sending production to India, to Latin America. I mean, Mexico, it's a great case of nearshoring, and we have seen a lot of that. So could you develop more on why do you think that it's happening that?
Thank you for your question. Shenzhou indeed currently is very diversified in terms of geographical locations. It has although China is the largest market, it still has very balanced weightings in sales in other regions like Japan, US, and Europe. So I think compared to other peers, because the other peers like Eclat and also Fengte, they have over 60% sales in US, which is very concentrated. So I think we think Shenzhou is currently already very diversified, and in the future we also see the China market still recovering in consumer and also in the sportswear. Like for example, in our visas 3, anti and leaning is also expanding. So in the future, I think Shenzhou is in a very good diverse position. Thank you for your question.
And also related to that, I mean, you showed your expected growth in revenue, and I only saw 2 years of historic information, but those 2 years seem flat, and then just like hockey stick again, no? Revenue is growing really fast. And the issue here is that if you are expecting that tariffs will have an impact, and probably companies like from the US or other countries who will diversify away from China, I'm not sure if it's a good assumption to say that the revenues will grow.
Thank you for your question. Based on our revenue projection, our way is to break down by core clients, and then we list out the cost of goods sold for each client, including Uniqlo, Nike, and Adidas, and also listed the market share. And we could observe, because we also expect the US sales being weakening, so we try to trim down the growth for each of the cost of goods sold in the client. But another thing that we think is very important is the industry consolidation, because under the US recession or the weaker overall demand, Shenzhou has a really strong balance sheet compared to other players, so it's least likely to cut orders from its top clients. And secondly, it could also last longer and maybe even can gain a market share during industry consolidation when the demand is weaker. So we expect the increase in market share of Shenzhou could offset the slower revenue growth in these top clients.
And also to add on to my group mate, please refer to Appendix E4. Shenzhou actually diversified its supply chain to other ASEAN countries such as the Vietnam, Cambodia, and Indonesia with lower tariff rate. And in fact, Shenzhou only accumulated for 16% of the sales in the US, and actually Lululemon accumulated the most with 60%. However, Lululemon, as seen in the graph on the left, they actually do not export this products from China. So I would think this risk could be mitigated.
What about their exposure to Nike, say in China in particular? I mean, Nike, I would imagine it might become less cool in China as a result of what's going on with politics, and it's been a very important market for Nike. Do you see that happening, and how much risk do you expect that could have to their earnings?
So thank you for your question. So we expect that the boycott in China is going to be like a short-term risk, which is going to affect the Nike in a very short term. Therefore, our investment thesis emphasize on the management reshuffle on Nike regarding as a long-term catalyst, and also we expect that Shenzhou could like the impact on Shenzhou is gonna be minimized because Shenzhou had a diversified customer base with so now Uniqlo has already replaced Nike as the top customers. So we expect that the effect on Nike sales is to be like minimal regarding to Shenzhou.
And another point to add on, because considering they are like boycott to Nike in China, but actually Shenzhou has a very diversified client list, including like also those local brands like Anta and Li-Ning. So eventually, after those boycotting issues, those other clients could absorb the loss in the sales in Nike in China. So eventually, Shenzhou could still benefit from this overall growing trend in sportswear in China.
How have you incorporated the forex exposure to your assumptions going forward?
Yes, because currently the sales of Shenzhou in China actually is settled in renminbi, but for other parts, around 72% of the other sales are settled in USD. So according to this slide, we have conducted a sensitivity analysis between the change of USD and renminbi, and we can see that although the profit becomes more sensitive to foreign currency exchange rate, but Shenzhou could still mitigate risk through bulk purchase cotton early in the year to lock the cost of goods sold, as well as to buy forward contracts to lock the exchange rate for future dates.
Um, yeah, let me ask a question. So, so suppose I'm a, you know, China PM or Asia PM, and so this is basically OEM slash ODM, and I would think that a lot of value add actually goes to the brands such as Li-Ning or Anta. So if in other words, if I can buy Apple, why would I buy Foxconn or Pegatron? If I can buy Li-Ning or Anta, why should I buy Shenzhou? Would you have a good answer to that?
Yes, thank you for your question. So a simple answer would be it's really due to the primary reason is really due to their diversified customer portfolio. And we can see from this graph here, actually, Shenzhou is not just a pure OEM. It is also an ODM with significant innovative capabilities. So for example, we can see that it actually collaborates with Uniqlo and Nike in terms of designing new fabrics like Aerosom and Flyknit. And this is also one of the key reasons why their customers are so sticky to them. And they cannot just simply shift away to new brands and new suppliers, because all this the new fabrics and new garments are actually relying on Shenzhou for their design. And this is also another reason why they could attract new clients like Lululemon, who has high demand for their fabrics and also the design. And with that, we also see a margin expansion potential in the future, since Lululemon is like a premium sportswear brand with more demand for the complexity in design. And this is also why their products also actually offers a higher, like 2 percentage point higher gross margin for Shenzhou.
Yeah, thank you for the answer. And let me ask you another question. So, this is regarding the valuation, and it's so it seems that they are undervalued in terms of PE compared to their peers, but in terms of EV to EBITDA, they are not. I mean, they are very similar. What's unique about their income statement or balance sheet that makes them, relatively, closely valued in terms of EV to EBITDA, but undervalued in PE?
Thank you for a question. Maybe I can explain why there's a PE gap between Shenzhou and its peers. Mainly because Shenzhou is a China company, and before most of the revenue is from China, and compared to its peers, because its peers have 60 to 70% revenue from the US, and before because the market has like a more bullish view on the consumer side of US. So actually, the other peers have greater PE ratio. And second reason is because of the current over penalizing of the tariffs. Shenzhou dropped the most on the day that tariff was announced. So this leads to a huge gap for valuation. But what we see in the market now is actually the US market has a really huge shock in revenue. Meanwhile, actually China is trying to improve. So we could see a close in valuation gap between the companies in the PE. And in terms of EV EBITDA side, you could see here in the EV, Shenzhou has a very strong balance sheet with a lot of cash and also very little debt. And its net cash is around almost 10% of its equity value. This means it has a very much higher EV compared to its other peers. So this leads to like a shorter or a lower gap between Shenzhou and its peers. Hope this could answer your question.
Can you talk about the any issues they've had with treatment of labor? That's been a huge issue for many Asian apparel companies.
Could you just quickly go to slide C C8? Yes, thank you. C8. So actually, we noticed that there has been a huge controversy about the Xinjiang cotton and also forced labor in China previously. And so actually, Shenzhou is like a leader in this aspect, which they are in line with the peers that they also conduct external inspection, which is up to the global standard of SLCP. And in addition, they also do conduct external audits conducted by their clients, which like major clients like Nike, Adidas actually did open up an office inside their factory to such that they can actually conduct random checks on the labors. And on top of that, they do have an internal well-established code, which they have a employee verification system, which they are using it to ensure that their labor is not there is no child labor, and that's we believe that with all these well-established mechanisms inside the company, they are well in line with their and well up to the industry standards for this part.
What about back to the valuation just a little bit? Can you talk about historical PEs and how it compares to its history? And then why you think that it sounds like you're saying it should have a premium to its historical PE, perhaps. Why does it deserve it?
Thank you for the question. And here's the historical PE. We could see actually it stood at a very high PE ratio to around 50 to 60 in the term like 2020 and 2021 before the COVID because of the China story. Because Shenzhou actually before relies a lot on China production, and China at that time is growing in a very good space, good pace and like a 10 to 20% growth every year. But now because of the China market slowing down, the growth is slowing down, so the PE is significantly discounted. And we actually think Shenzhou is currently over-penalized by not only the impacts but also its growth potential, and also given that it has a very strong balance sheet and also a very strong fundamentals, including like its technological advancement compared to its peers. So I think it should have a justified greater valuation instead of like a huge 30 to 20% discount to its peers and also to its historical data.
How does its ROE compare to peers?
I think in terms of the ROE data, because Shenzhou is actually operating at a higher margin and also studing at a high growth and also higher profit margin sector. So actually, it has like a greater margin compared to its peers. Like for example, its peers Eclat only have profit margin of lower than 20%, but Shenzhou has over 20% of profit margin. So Shenzhou is actually shooting at a high ROE compared to its peers, and I think this trend would continue because Shenzhou unique advantages is justified, and we believe the advantage could not be eliminated in short term.
Can you talk about the growth rate of the local brands and how big that's what I'm calling them. Sorry, I don't know what you call them, but in terms of how big they are to the entire company at this point and how much impact they could have on their earnings growth?
Yes, can we just go to Appendix B10? Yeah, so actually, the Chinese outdoor sportswear is a unique subsector that is actually fast growing, especially when compared to the broader apparel sector. And this is really due to the policy that the Chinese government is rolling out. And for example, it is expected that the market will grow to RMB 3 trillion by this year. And going to the next slide, we can see that the domestic brands are actually growing very quickly. And we see that going forward, Anta, Adidas, and Lululemon will continue to gain share in the Chinese market. And this is really due to their products that are really targeting and aligned with the Chinese customers as they are focusing on high functionality. And actually, we are seeing that the domestic demand will remain strong as just in the the first 2 months this year, we already see that only talking about the online sales, the sales of sportswear and like the top 4 e-commerce channel like Taobao, it already jumped 60% as compared to last year. So we are expecting. Thank you.
Okay.
Is your portfolio ready for energy transition? Meet Burkhardt Compression, Swiss engineering leader in the race to clean energy. We are from the University of Neuchatel, and here's why this stock belongs in your portfolio. Based on the 3 drivers. First, the company is well positioned to capture market growth. Second, product mix shift improve EBIT margin. And third, technical edge unlock higher revenues and margin. We issue a buy recommendation with a target price of 645 Swiss franc and an upside of 17%. Reciprocating compressors are crucial for critical industries. They support supply chain from production to distribution. With the energy transition underway, their importance is further emphasized, positioning the market to reach 8 billion Swiss francs by 2029. What especially compelling about this industry is the resilience. 40% of revenue come from mandatory maintenance, which ensures steady demand even during downturns.
In the competition, Burkhardt stands out with a market share of 16%. The company differentiates itself through specialization and the high number of patents, which sets them apart. In the industry, Burkhardt operates through 2 divisions, systems and services, with its key revenues coming from gas and petrochemicals, with China and Europe as leading markets. This strong positioning, with the focus on the energy transition, allows Burkhardt new growth opportunities.
Our first driver highlights Burkhardt's unique position to capitalize on the energy transition. Solar is one of the fastest growing energy markets, where Burkhardt captures revenue supplying hypercompressors. These are essential to the production of EVA, a key component in solar panels. In this segment, with only one major competitor, Baker Hughes, Burkhardt ensures unmatched performance, making it the go-to provider of compressors. In the LNG market, Burkhardt captures revenue supplying compressors for gas transport and storage. Global developments are accelerating investment in LNG vessels and terminals, infrastructure where Burkhardt excels. With superior durability and efficiency compared to Atlas Copco and TMC, it's positioned to capitalize on this opportunity. Hydrogen is set to contribute 17% of systems revenue by 2029. As global infrastructure builds out, compressors are required at its every stage. The ability to serve the every step of the value chain positions the Burkhardt to capitalize on this opportunity. While hydrogen offers significant potential, we maintain a cautious outlook given its early stage. Burkhardt's superior products position it to capitalize on these key segments. And when we spoke with industry experts and key customers, one thing really stood out. Burkhardt's compressors are essential across all energy applications. The market overlooks how resilient the company is, because no matter how the energy mix evolves, its compressors stay essential. That's why we see it not just as a transition story, but a long-term growth opportunity still underappreciated.
Supporting the system division, Burkhardt's unmatched cross-brand compatibility position it as the leader in the third-party service market, which we project a rising service share for non-Burkhardt compressor as a result, contributing to 551 million Swiss francs by 2029 as the company expands to its key markets. Burkhardt's unique service ecosystem locks customers in through razor play model, proprietary technology, and safe reinforcing service loop. This strategic model is extremely costly to replicate or switch, and thereby securing strong customer loyalty. So why do customers choose Burkhardt? Based on the feedback from 12 clients, Burkhardt consistently outperforms competitors on key metrics such as predictive maintenance accuracy. Combining increasing service share and strong customer loyalty, we expect higher service mix by 2029, which in turn improve EBIT margin to 13.3%.
Burkhardt maintains competitive edge by focusing exclusively on the reciprocating compressors, investing 2 to 3% of its revenue into R&D, outpacing competitors whose budgets cover broader compressor categories. To validate this, we analyzed patent data and found that Burkhardt holds the highest number of patents specifically related to reciprocating compressors. Building on this commitment to innovation, Burkhardt's value engineering products are delivering significant cost savings. We conservatively estimated the savings to reduce the systems division COGS by 4.5%. These three key drivers form a comprehensive strategy that drives sales growth, controls COGS, and improves margins over the long term. And that's why Burkhardt deserves your attention.
For ESG, Burkhardt has different initiatives in place that are delivering measurable impact. Superior technologies supports the energy transition and lower the environmental footprint, while Burkhardt ranks among the top Swiss employers and leads with the highest share of executive compensation tied to ESG performance. These initiatives reduce the environmental risk, improve brand reputation, and align with investor perceptions. Our ESG analysis supports a 10 basis point reduction in our REC to reflect Burkhardt's recent sustainability improvements. We also spoke with industry experts that confirm that the major challenge remained the Scope 3 emissions, but Burkhardt's sealing technologies supports it and reduces methane emissions by 20%, which further confirms our 10 basis point REC reduction.
For the financial, we forecast revenue to reach 1.33 billion Swiss francs by 2029, driven by structural growth in the system division from rising compressor demand for low-carbon application, and in the service division from market expansion beyond install base, reflecting in a revenue CAGR of 5.3%. EBIT is set to expand by 90 basis points, reaching 13.3% in 2029. This margin gain is supported by the cost reduction initiative in the system division and higher service share in the product mix. Burkhardt outperformed peers in profitability with return on equity 2 times higher, supported by stronger net profit margin. With effective capital allocation and the shift to high-margin service, earnings per share and dividend are expected to rise to 41 and 24 Swiss francs by 2029.
Our intrinsic valuation of Burkhardt is driven by a strong improvement in their working capital efficiency. We project net working capital to sales to improve to 15% by 2029 And this is supported by a recovery in their receivables after last year's invoicing spike and a shift towards shorter cycle service projects. CapEx is estimated to remain at 2 to 3% of revenue, in line with guidance. Combined with a cost of capital of 8% and a terminal growth of 2.5%, this supports a target price of 645 Swiss francs and an upside of 17%. We also conducted a scenario analysis by adjusting our key assumptions to further validate our discounted cash flow model. In the bear case, we expect slower energy transition and increased competition to drive the share price down to 455 Swiss francs. In the bull case, however, we expect favorable environment for hydrogen projects and accelerated product mix shift to drive the share price up to 757 Swiss francs, a significant 35% upside. Overall, the scenario analysis presents an attractive risk-reward profile for the company. Our relative valuation further confirms our buy recommendation. The company's substantial service division warrants a higher target EV to EBIT multiple similar to its service peers. By using a revenue-weighted approach, we calculated a target EV to EBIT multiple of 19 and an upside of 22%, further confirming that the stock is undervalued. We also conducted a Monte Carlo simulation which supports a buy recommendation with a 72% probability. While all our models support our thesis, our final target price of 645 Swiss francs is 100% DCF determined and represents a 17% upside. As for the investment risk, the recent US tariffs don't present a direct risk to Burkhardt's operations, but a strong appreciation of the Swiss franc caused by the uncertainty around the tariffs could affect the company's competitiveness and profitability in the short term. The company is also exposed to cyclical end markets such as LNG and petrochemicals. But the company's growing service division and growing global footprint partially mitigate these risks. With a target price of 645 and an upside of 17%, Burkhardt is a strong contender for any portfolio. With strong fundamentals and momentum, this stock is truly engineered for tomorrow. We are from the University of Neuchatel, and we thank you for your attention.
Thank you very much. I have a technical question. Why did you use the multiple of enterprise value over EBIT and not over EBITDA?
So we found out that Burkhardt is a very profitable company, and all the companies that operate in this industry are very profitable at the same time. So EV to EBIT making use of EV to EBIT made better sense than EBITDA, and it was also accounted for differences in capital structures.
But why? I mean, in this industry, depreciation and amortization, essentially depreciation, should have an impact in cash flows.
Yes, but if you only look at the systems division, yes, depreciation and cash flows are impacted a lot. But the companies that operate in this industry have a service division that have a higher margins, and EV to EBIT presents that case in a better manner.
Okay.
I was looking at the EV/EBIT multiples you have. I think for their service division is like half of where the peers are, whereas for the other division, the machinery is more or less at their peers. Is there a reason why the market seems to heavily underprice their service division?
Historically, the markets have been always valuing Burkhardt as a pure machinery player, and that's why we see that when we compare it just to their machinery peers such as Baker Hughes and Atlas Copco, they seem to trade at par. But given that substantial service division, which is around 35 to 40% of the company in our projections, we believe that the Burkhardt has to trade in line with its service peers, and we've also included certain companies like Schindler and Kohn that better present a service-oriented structure. And for this reason, we feel they are undervalued when we consider the improvement in service that's going to happen in the next 5 years.
Why do you think that the service portion is discounted if it's higher margin and it's growing faster than the rest of the business?
I will take this question. Service is expected to capture a higher margin is because of the two reasons. The first reason is that Burkhardt currently have unmatched cross-brand compatibility that allow the company to expand to third-party service market into other brand and often compressor market. Second of all, Burkhardt have superior technology leadership in digitalization, which can capture higher market share for digital solutions.
Let me ask a question on your ESG slides. So it seems, so two questions. A, you looked at Refinitiv's scores and you came up with your own scores. What on which areas do you think you do did you give a better scores than what Refinitiv did? And why? What made you think that you're much better than Refinitiv? That's the first question. The second question is, now it seems you gave a lower WACC because of good ESG score data. Is there any academic paper or paper from the industry that says good ESG scores lead to change in WACC?
I agree with that. I was going to ask the same thing. Because at the end of the day, I've seen a lot of research that says that ESG do not necessarily increase returns. So kind of goes against that.
Okay, I start with the first part of the question. So for the differentiation between Refinitiv and our scores, so there's a high level of degrees of freedom between Refinitiv and our score. There's a difference in methodological differences and the lack of standardization, because the rating agencies, they can weight the indicators differently, which leads to inconsistent outcomes. And we found, based on Burkhardt, that Burkhardt is highly penalized by the Scope 3 emissions. Because when we have done our ESG analysis, we have found that they were doing measurable progress across the Scope 3 emissions. They have, for example, sealing technologies that reduce methane emissions by 20%. And this helps the LNG market.
And I can take the second part of your question with regards to whether ESG is really important and this does play a role in increasing the returns of a company. So while we didn't consider ESG by impacting the cash flows or revenues, we've taken it to affect the risk of the company, as we believe that the other rating agencies have presented a wrong score for Burkhardt, considering that they are a machinery company and their Scope 3 emissions are really bad. But like my colleague said, their impact on the LNG market is very profound, and this could potentially lead to them reducing the overall risk of the market, which is prone to methane emissions and which is also affected by stronger environmental regulations. So by doing so, they're not only helping the LNG market itself, and by also helping themselves by reducing the overall risk.
Okay. I mean, it's a little bit different because if you look at Europe it's pro ESG, and the US, actually the SEC do not recognize the different methodologies because there's no way to agree.
Yes, I agree with you completely that there are the differences between US and Europe. But when we consider this company, we also took at which countries they have operations in and where the regulations affect them deeply. And we figured out okay, they have very less exposure to the US market and have more exposure to the European and Asian markets, especially China. And they have stronger projects in place and regulations in place and also targets, which also support the company's goals.
Okay, understood. I guess we haven't asked about tariffs. What will be the impact of tariffs in the company?
So the US tariffs don't present a direct risk to the company's operations, but given the uncertainty surrounding the tariffs in recent times, there's a stronger Swiss franc does affect its competitiveness and profitability because of the currency translations that take place from the regions of their operations, such as China and India. So although this is going to affect them in the short term, we don't believe this is going to continue in the long term, and we are waiting, depending on the decision from the Swiss National Bank, it can play out in very different ways. And in our worst case assumption, given that US imposes a 33% tariff on Switzerland, our worst case assumption is Burkhardt would have to re-implement its strategy and consider relocating its facilities into the US by localizing supply chains and by also removing any existing facilities.
So moving to the US?
Yeah, localizing it in US, the production lines.
Move to Mexico is cheaper.
I have a question on the valuation. I noticed your final target price is purely the DCF valuation. Is there a reason why you opted to exclude relative valuation?
I will take the question. So the reason that we choose 100% DCF for our model is because of three reasons. First of all, the DCF model best capture the fundamental value of the company regarding specific growth driver, such as the revenue growth supported by energy transition into low carbon application and the service expansion. That trading multiple don't reflect that. And second of all is that Bookat don't have a full set of comparable peers and competitors. And the third reason is that with the DCF we can account for multiple scenario and sensitivity analysis, especially in the context of market volatility right now, and the relative valuation as the cross check only, because it's less reliable due to the fact that Bookats have very few direct competitors that share similar business model and margin profile.
Yeah, I had the same question. I will comment for you and for everybody in the room. From my perspective, to issue a buy on a stock, 20% or more upside is probably more appropriate to feel like it depends on the risk of the stock, but that's kind of more what my personal target was when I was going to pitch to a portfolio manager. So if you have less than that, I may be dinging you a little bit for that, but sorry.
No, I think it's a great point.
I kind of looked for 2 times upside to downside. So if I got 20% upside, I might look for 10% downside. And I was usually using relative valuations because of time constraints, just to give people an idea. What about in terms of just if you had any suggestions for this company to improve its strategy in any way, what would you offer to the management team?
So, when it comes to management's strategy, they have a proven track record of localizing the supply chains, which is proving very useful in the recent times. And I would continue this direction. So the company is strongly developing in APAC region, and they have a separate subsidiary in China, which has reduced the market risk in China very significantly, and they are doing the same in India. So they are localizing their supply chain. They're building their factory. So they are focusing on localizing the supply chains all over the world to mitigate any risks that come from the recent market volatilities. And that's something that I would definitely focus on in the future and continue this trajectory.
Is there a place in the world that they can do more of that?
So as I said, that's mainly the APAC region where they have been penetrating the market very aggressively, and so that's the place I would focus on. But also the US. So as we said, the exposure to the US is quite negligible as of now. But they have very strong potential to grow there, and it might be proved useful to grow there with the recent volatility in the markets.
I have a question on the cost of capital. I noticed it's you mentioned it's ESG adjusted. I guess it's a quick follow up to the previous question. So quantitatively, how do you adjust cost of capital to ESG?
So for the WACC reduction, we had a look at Refinitiv, historical methodology, and they used around 10 basis points for moderate ESG improvements, and we didn't want to overstate Burkhardt's ESG improvement, so we wanted to keep it conservative, and that's why we chose 10 basis points.
Did you estimate the value without using your methodology with the other one that you kept?
So I believe you're referring to the fact that without the ESG adjustment, is that right?
No, if it was not your methodology, but a public one or another one.
So it was mostly based on MSCI's working paper on on the standards they proposed to how much basis points we can assign to a particular range of scores. So we also followed the same methodology by MSCI.
Okay. Any important risks that you see to your forecast, to your recommendation?
So a significant risk for the company would be the slower process of the energy transition. So the company is well positioned to serve these transitioning markets like concerning energy, so solar, LNG, and hydrogen. And that's where their growth trajectory is most focused now. So if the energy transition doesn't happen, they are still well positioned to capture the traditional markets revenue, but they would have to reorganize their R&D efforts and also their growth trajectory when it comes to geographic expansion. So this slower growth of the energy transition trend would be a major risk for the company.
Can you give it some background on the 40% of the sales that are non-discretionary to their customers? Like, why is that not discretionary? What is it?
I can take this question. This is because of the characteristic that compressors serve mission critical industry, including both the traditional and transitional markets such as petrochemical, oil and gas, and this kind of activity have to operate continuously and subject to really costly downtime, and therefore maintenance is non-discretionary. And for that reason, it keeps the strong recurring revenue for the industry.
Does management or do you have a view on what the so obviously I believe Switzerland is a very high cost of labor country. If they go to APAC, how the margins might change if for their presence in APAC as management, or do you have a view?
Regarding their position in APAC, we are mostly in line with guidance. And we believe that, they have production facilities in China and India. And in China, they have a completely owned subsidiary. So it entirely serves only the Chinese market. And in India, they use it for exports as well. So they have a pretty good margin projections for India as well. And so we mostly remained in line with the guidance.
$10. Okay.
Yeah.
Time.
Okay.
So let me say, this is one of my favorite days of the year. Looking at all of you, and by the way, you all look good and really smart in your dark suits, and someday you too will be able to wear pink. But it is a great day, and I will tell you, I've judged this conference or a challenge a number of times. I'm from Canada and have done both Toronto's years ago and Global's. And let me tell you, as somebody from the investment profession, we always came away and said, if only companies would do as good a job as what happens in the research challenge. And so keep it up. Your standard is excellent. And the fact that all of you are here is extraordinary. You should feel just tremendously proud. And in a world of competitive nature, the winner of the 2025 CFA Institute Research Challenge is Kozminski University.